Hello, Rockstars. Hope you're all doing amazing. We are here to revise CA Final SCMPE, a new chapter, Divisional Transfer Pricing. So, all concepts of divisional transfer pricing and all questions of ICAI we'll try to cover in the minimum possible time. Our aim is to cover all the questions and all the concepts conceptually within 5 hours for all of you guys. Yes. So before we start, always keep learning, always keep smiling. Smile is very important. A smile doesn't mean that you are happy. A smile doesn't mean that there are no problems. A smile means that you are strong. You're strong. You're ready to face all the challenges. So with this small motivation, let us begin our chapter, Divisional Transfer Pricing. So first, let us have an analysis into the past examination. Very important chapter from the examination perspective, 20, 10, 0, 10, 10, 20, 10, 20. Almost every attempt, we have 10 marks. There are attempts when there are questions of up to 20 marks as well. On an average, the weightage is of 13 marks. Very important from the examination perspective, very scoring, very practical chapter. So this entire chapter we bifurcated into 3 topics. First, we'll be looking at the basics. Then we have the methods of transfer pricing. Then we have transfer pricing range and the concept of goal congruence. And finally, we have the miscellaneous areas. So let's begin with the very basics of transfer pricing. So SCMP is scary. No, SCMP is scoring. It is all about the mindset. So with this, let us begin a new chapter, transfer pricing. The first thing, when is transfer pricing applied? Yes, what is transfer pricing? When is it applied? So assume we have a company and we have 2 divisions, division A and division B. So we have 2 divisions of the same company, and one division transfers goods or services to the other division. So the price at which the goods are transferred is called as transfer price. So when is transfer pricing applicable? When goods or services are transferred from one division of an organization to other division of the same organization, then the price at which the transfer takes place is called as transfer price. Yes. So the division which is transferring the goods or services is called as transferor division. The division which is receiving the goods is called as receiving or transferee division. The price at which goods or services are transferred is called as transfer price. Is it clear, students? Yes. Now, pricing could be of 2 types. We could be either selling to our external customers or we could be selling to our internal customers. If we are selling to our external customers, the price is called selling price. It is discussed in chapter 7, pricing strategy. But if we are making a transfer to our internal customers, then the price is called as transfer pricing. It is discussed in this chapter. Now, let us try to understand it with the help of few examples. Fast and quick, let's understand it with the help of few examples. First, we have Google. Yes, Google has 2 divisions. One is the Android division, which manufactures the Android software. One more, we have the Google Pixel, that is phone manufacturing division. Every Google Pixel phone wants the Android software. Yes, so it wants the services, the support from Android software. So what happens? For every Google Pixel phone, we want one Android software. We want that license. We want the key. Yes, so what happens? Yes, Pixel asks Android software to provide them the services. So what is the price Android division is charging? That price is called as transfer price. So when goods or services are transferred from one division of an organization to other division of the same organization, then the price at which goods or services are transferred is called as transfer price. Next example, Cafe Coffee Day. You all guys know Cafe Coffee Day? Yes, all of you guys have been there for dating. Yes, sir. Yes, a beautiful place. Yes. Now, what all Cafe Coffee Day has? Obviously, Cafe Coffee Day has their CCD outlets wherein we go, we enjoy, we have a look at all the places. But they also have their coffee estate wherein these coffee beans, we grow them. So first, we have the coffee beans. We have the farms wherein coffee beans are grown. Next, we have the CCD outlets. In the CCD outlets, they manufacture, they give us coffee. Yes, for the coffee, they want the coffee beans. They get it from these farms wherein coffee beans are grown. So the price at which these coffee beans are transferred to CCD outlets, the price is called as transfer. One more example. Yes, transfer price need not be between two divisions of the same company. It can happen between a group company as well. Because eventually, if it is a group company, all the profits go to the same group. So, suppose we have Tata. Tata has Tata Steels. Tata also have Tata Motors. Tata Motors, if they are manufacturing any car, suppose they are manufacturing Tata Harrier, they want the steel. Where do they get the steel from? They get the steel from Tata Steel. So the price at which goods or services are transferred from Tata Steel to Tata Motors, the price at which steel is transferred is called as transfer price. Is it clear, students? So what is transfer price? When goods or services are transferred from one division of an organization to other division of the same organization, the price at which such goods or services are transferred is called as transfer price. Let's have a look at this. Is it clear, students? Should we continue in this? When goods or services are transferred from one division of an organization to other division of the same organization, then the price at which the transfer took place is called as transfer. Division which transfers the goods or services is called as transferer or supplying division. Division which receives the goods or services is called as transferee or the receiving division. And the price at which such transfer takes place is called the transfer price. Now, pricing could be of two types. Either it could be for external customers or it could be for internal customers. If it is for external customers, it is called selling price. We've discussed this in a separate chapter, pricing strategies. Yes. If it is for internal customers, it is called transfer price. We are going to discuss it in this chapter. One more simple thing, why transfer pricing is introduced. Yes, a small theory concept, not much required. Yes. Why is it introduced? Initially, all the profit was centralized at the organization level. So these divisions were just manufacturing goods, transferring to each other. But what happened? There was no healthy competition. Employees were not competing amongst themselves. They are not having any specific goal. So what we did, in order to promote healthy competition, in order to evaluate the performance of all the divisions, what we did that even though you're transferring goods internally, let us set a price so that the transferring division is earning profit. Yes, he will be in a position to evaluate its performance. Okay, yes. So it helps to develop a commercial attitude amongst the employee and helps to get the best output from them. It's not required from the examination perspective. Now, other basic points which has to be kept in mind. Firstly, contribution of company as a whole. Yes, let us try to understand it with the help of an example. Suppose we have, throughout this chapter, we'll be taking the example. We have Google, we have one division Android, we have one division Google Pixel phones. We are transferring Android software to Google Pixel. This example we are going to use throughout as a standard. So, Android division, assume the variable cost is 1000 rupees. The transfer price is 2000. Mobile manufacturing division, assume other variable cost. Yes, once we've got the Android, other variable cost also we want. Yes or no? We want the memory chip, we want the screen, yes, all other things. Yes, for that, the other variable cost is 5000 and suppose the selling price of the phone is 10,000. We want to calculate what is the contribution of division A, it is Android, what is the contribution of mobile, what is the contribution of company as a whole. First, division A. What is division A doing? It is transferring Android. At what price it is transferring? 2000 rupees it is transferring. Yes. What is the price it is incurring? What is the cost it is incurring? 1000 rupees is the cost it is incurring. So how much is the contribution it is earning? 1000 rupees is the contribution Android division is. Now division B, mobile, Pixel phone. At what price we are selling? We are selling at 10,000 rupees. For this, what all variable cost we are incurring? Firstly, look at this. We want other raw material. We want a screen, memory card, etc. For which we are paying 5,000. So 5,000 is that variable cost. Also, we want the Android software. For that, we are paying 2,000. So altogether, 7,000 is our variable cost. 10,000 is the selling price. 3,000 is the profit. So division A it is selling 1000 is my contribution. Division B is selling 3000 is my contribution. So for company as a whole, what is the contribution, students? 4000 is the contribution. Either you can get contribution for company as contribution of division A, contribution of division B, or else you can look at it from the perspective of company. Now we have looked what is division A, what is division B. Now look at it from the perspective of company. What company is selling? Whether company is selling Android, no. Android is internal transfer. What company is selling? Company is eventually selling the phone. How much revenue company is getting? Yes, company is getting 10,000 rupees from the end customer. For that, what all variable cost company has to incur? From company it should go. Yes, this is company, this is division A, this is division B. From division A to division B, whatever is the transfer, do not consider. What we are incurring from the company. We are telling from the company. Division A is incurring 1,000 rupees. Division B is incurring 5,000 rupees. So altogether, company is incurring 6,000 rupees. So company as a whole, how much contribution it is earning? 4,000. Either you can do, if you want to calculate the contribution of company, you can see it as what is the sales of the company, what is the variable cost of the company, you get the contribution. Or else you can do it as what is the contribution of division A, contribution of division B, go on adding contribution of all the divisions, you get the contribution of the company. Is it clear, students? Should we continue? Yes, everyone. Now, impact of change in transfer price on the company. What happens if there is a change in transfer price? Look at this. What is transfer price eventually? It is a revenue to one division, cost to other division. So eventually, if you look at it from the perspective of company, both get cancelled. So whatever you set the transfer price, eventually for the company, it doesn't make a difference. Now look at this. If transfer price was 2,000 rupees, what was the profit the company earned eventually? 4,000. Now let us consider if transfer price is 3,000, what will happen? Division A will tell, yes, my revenue is 3,000, 3,000. My cost is 1,000. So my contribution is 2,000 rupees. Division B is telling, I am selling the phone, I am getting 10,000 rupees. Other variable cost for screen, etc., I am paying 5,000 rupees. And to get this Android, I am paying 3,000. So altogether, my cost is 5 plus 3, 8,000. My contribution is 2. How much is the contribution for a company as a whole? 2 plus 2, 4,000. Again, you look at it from the perspective of company. Company is selling, yes. From company perspective, what is the revenue? We are eventually selling only the mobile. So our revenue is 10,000. What is the variable cost from company? Division A is paying 1,000 rupees. Division B is paying 5,000. Altogether 6,000 we are paying. So contribution is 4,000. What we are telling? Yes, transfer price. It is gain for one division, loss for other division. But for company as a whole, the impact is zero. Whether you set the transfer price 100 rupees, 1,000 rupees, 10,000, 1 lakh, 10 lakh. For company as a whole, the impact will be zero because it will be revenue at one place, cost at other place. For company as a whole, both gets cancelled. So change in transfer price doesn't affect profitability of company as a whole. Why? Because gain of one department is netted off by loss of other department. Is it clear, students? Next, and an important thing throughout, everywhere in divisional transfer pricing, apart from the calculation, yes, wherever there is any explanation required, yes, one important term we need to use everywhere: goal congruence. Yes, in case of divisional transfer pricing, there arises a problem of goal congruence. Yes, what is goal congruence? Yes, goal congruence means my goal is also same, your goal is also same. Yes, that means that goals are congruent. Yes, I want you guys to become a CA. You also want you guys to become a CA. Then, yes, we can together work. Yes, ensure that you guys are becoming CA. Yes, but you guys want to become a CA. I don't want it. Yes, our goals are not congruent. But I want you guys to be a CA, but you are not interested. You are least bothered. It will not happen. So now see, we have two divisions. Division A, transfer division we have, receiving division we have. What transfer division wants? Transfer division, I am transferring the goods. Yes, what is it telling? Yes, I'm transferring, I'm selling the goods. While we are selling, yes, what do we want? We want selling price to be maximum or minimum. What do we want, students? While we are selling, we want the selling price to be maximum or minimum. Tell me, students. Yes, while we are selling, we want the selling price to be, we are selling the goods. We want the selling price to be maximum. Yes or no? Yes, that's the transfer division wants the transfer price to be maximum. Because more the transfer price, higher will be the profit. Transferee, the person who is receiving the goods, suppose you are a purchaser, you want to purchase the goods, you want the purchase price to be maximum or minimum. What you want the price to be? You want the price to be minimum. So transferee division wants the transfer price to be minimum, because minimum the transfer price, minimum the purchase price, maximum will be the profit of transferee division. Yes. So transferor tells, yes, I want to keep the transfer price more. Transferee tells, no, no, you should keep it less. So there will always be a problem of goal congruence. So what we need to do, if actions of the divisions are not in the best interest of the company, then company has to intervene and ensure that decisions are made in the best interest of company. Yes, we'll discuss it later, but we are telling that if divisions are fighting and they are taking any decision which is not beneficial for company as a whole, yes, so then company should intervene and ensure that, yes, this is not happening. They will take a decision which is ultimately beneficial for company. Now, I'll give you a small example. Suppose we have Android, we have mobile. Okay, two divisions. Android, yes, mobile people are telling, I can get a similar service, okay, from Zedroid, not Android. Yes, a cheaper version Zedroid, I will get it at 1500 rupees. Android people are telling, no, no, minimum will be charging 2000 rupees. So what mobile people do? They go and buy from Zedroid. Actually, this 2000 rupees which we are transferring, our variable cost is only 1000 rupees. Now see, from the perspective of company, if you buy from Android, how much variable cost we are incurring? As a company, how much we are incurring? 1000 only. But if you are buying from Zedroid, how much we are incurring? We are incurring 1500. So which was beneficial? Yes, we should have purchased from Android. So what they are doing, they are taking a decision which is not in the best interest of company. Company should intervene and ensure that no, you guys are purchasing it from Android itself. Yes, is that clear, students? Next, all these are the basic points. Selling expenses in case of internal transfer. Why do we incur selling and distribution expense? To sell the goods, to market the goods. In case of internal transfer, is there a need for marketing, students? There are internal division, so there is no need for marketing. What we are telling, in case of internal transfer, generally, most of the cases, selling and distribution expenses are not incurred. Okay, so if it is given in the question, we will not include it as cost. So selling and distribution expenses, two different scenarios could be there. Yes, first, if question is specifically telling, question is telling selling and distribution expenses is 4 rupees. Question is specifically telling you, yes, this is incurred for internal transfer, or this is not incurred for internal transfer. Question is telling, question is ultimate. There is nothing beyond the question. No logic, nothing. If question is telling you to do anything, do as it is given in the question. Question is telling selling and distribution expense include in cost, we will include. Question is telling exclude from cost, we will exclude. But if question is silent, what will be the fundamental assumption we are taking? The assumption we are taking is that selling and distribution overheads will not be incurred for internal transfer. Yes, the assumption we are taking is selling and distribution. We are doing it only for external customers to sell the goods, to market. For internal customers, it is not required. Is it clear, students? What all we have discussed? First, we have told what is transfer price. Yes, when goods or services are transferred from one division to other division, the price at which it is transferred is called as transfer price. Next, yes, how do we calculate contribution of company as a whole? Either you can do total of contribution of all the divisions, division A, division B, division C total, or else you can see what is the sale of the company minus what is the variable cost of the company. That way also you can get. Yes, impact of change in transfer price. On the company, there will be no impact. On the profit of the company, there will be no impact. Yes, it will be gain for one division, loss for other division, but overall on company, there will be no impact. And we have told there will always be an issue of goal congruence. Transferor wants transfer price to be more. Transferee wants transfer price to be less. If they are taking any decisions which is not in the best interest of company, company should intervene and ensure that the decisions are ultimately taken in the best interest of company. Selling and distribution expenses, question specifically tells do it as it is, but if question is silent, assume that they are not incurred for internal transfer. Is it clear, students? Should we continue? Now, we have the first concept, methods of transfer pricing. Okay, how do we calculate transfer price? So there are mainly three methods. Firstly, cost based, second, market based, thirdly, negotiation based. So either based on the cost, we can calculate transfer price, based on whatever is prevailing in the market, we can calculate transfer price, or based on the negotiation, we can calculate the transfer. So what do these methods mean? Let us try to understand them one by one. So transfer price, we have cost based, market based, negotiation based. Cost based, we have full cost, marginal cost, standard cost, full cost plus markup. Market based, we have shared profit relative to total cost, shared contribution relative to variable cost, and we have negotiation. Yes, let us try to understand it with the help of an example. We have Google has two divisions, Android and Pixel. So in Android, the variable cost we are incurring is 1000, the fixed cost is 500. In Pixel, other variable cost we are incurring is 5000, fixed cost is 500. Now, yes, full cost based transfer price. What are we telling in full cost? We are telling whatever is my full cost. Transfer is telling is whatever is my full cost, at that cost I will transfer. So what is the full cost here? Yes, my variable cost is 1000, my fixed cost is 500. So I will transfer the goods at 1500. So here goods are transferred at the full cost, that is variable cost plus fixed cost. However, if there are any selling and distribution expenses which are not incurred for internal transfer, they may be ignored. Simple, that is full cost based. Next, we have marginal cost based transfer price. What is marginal cost based transfer price telling? Is what is the marginal cost we are incurring? How much extra we are incurring? What is the marginal cost, students? Here it is just the variable cost. So transfer price will be the marginal cost. Yes, in this example, it is just the variable cost, 1000 rupees. So we are telling we will transfer it at 1000. However, the complete marginal cost, we've already discussed in decision making chapter. What all will we be having in marginal cost, students? We'll be having the variable cost, we'll be having the specific fixed cost, we'll be having the opportunity cost. Here we are assuming specific fixed cost and opportunity cost is not there. So the marginal cost is only the variable cost. So Android will tell, okay, I'll transfer it to you at marginal cost. Whatever I've incurred 1000, I'll give it to you at 1000. Third, we have standard cost based transfer price. All these are actual, yes or no? Full cost, how much cost I've actually incurred. Marginal cost, how much extra cost I've actually incurred. Standard cost, we are telling standard on an average. Standard, I thought, to manufacture Android. Yes, for one Android, what is the standard cost? I thought that my standard cost will be 1400 rupees. So I'll transfer it to you at 1004. Irrespective of what my actual cost is, I will transfer it to you at my standard cost. Clear? And the fourth one we have, it is the full cost plus the markup. So here Android tells, yes, my full cost is 1500. I want a bit of markup. I want 20% on my cost as markup. 1500 plus 20% of 1500, 300. So I'll transfer it to you at 1800 rupees. It is cost based transfer pricing. Very simple. Full cost we transfer at full cost. Marginal cost we transfer at marginal cost. Standard cost we transfer at the standard cost. That is the cost which is generally incurred. And full cost plus markup we charge full cost plus an additional markup. Clear? This is full cost based transfer pricing. Let us have a look at this. Same example we have given. Now, cost based transfer pricing. The methods of transfer pricing, they are not that important. Only negotiation based transfer pricing is important. Yes, till now questions have not been asked. Yes, falls in the C category. Yes, there are a bit of theory. Just have a look at that. I'll just read it to you, not spending much time. Cost based transfer pricing. What is the advantage? Information is easily available because it is our cost. Information is easily available. Performance is based on benchmark to internal cost targets, which can be calculated. Yes, all these benchmarks can be calculated because all these are internal, not something external. What is the disadvantage? Manager of supplying division will have no incentive to reduce the cost. Yes or no? Manager of supplying division, Android division has got no incentive to reduce cost. He's telling whatever is the cost I'm incurring, I'll transfer it. So don't worry, if it is 1000, 2000, don't worry about the cost. That is one disadvantage. Yes, cost basis can be subjective. So when we are telling cost, which cost? Are you referring to variable cost? Are you referring to standard cost? Are you referring to full cost? That becomes subjective. And manager will try to use that basis which is beneficial to him. Suppose transfer is telling, yes, give it to me at very marginal cost. Yes, transfer is telling, no, I'll give it to you at full cost. So that fight can happen. Okay, this is cost based transfer price. Which all do we have? First, we have full cost based transfer price. Here transfer price is full cost. It is variable cost plus fixed cost. Okay, including whatever is the overheads. However, if selling and distribution overheads is not incurred, we need not include that. Next, marginal cost based transfer price. Is what is transfer price? Here we are transferring the goods or services at the marginal cost. What all is the marginal cost? Is variable cost, additional fixed cost, and opportunity. Same advantages, disadvantages. Next, we have standard cost based transfer price. Here we are going to transfer the goods at standard cost, whatever was the pre-estimated cost. Here we have one advantage. Okay. Yes, it removes the limitation that higher cost will lead to higher transfer. Previously, what was happening in full cost and marginal cost, whatever was my actual cost, that I was transferring. Suppose I am telling, yes, my variable cost is 1000, my fixed cost is 500 actually, so I will transfer it at 1500 based on full cost. But in standard cost, what I am telling, actual cost I won't consider. Whatever is the standard cost. Suppose 1400 is my standard cost, I will transfer it at only at 1400. If you are incurring extra cost in your supplying division because of your mistake, will not transfer it to other division, you only will be held responsible. So supplying division will have the responsibility. It will try to control the cost. It was not happening in the previous two methods. Okay. Next, finally, we have cost plus markup method. Yes, here we are transferring it cost plus markup. Till now, what was happening? Yes, full cost, marginal cost, standard cost. Yes, supplying division had no motivation at all because whatever is the cost, only that we are getting. We are not getting any profit. But now they are motivated because if we sell the goods, we are getting profit. Profit is what ultimately makes us happy, right? Yes, so here they are motivated. So supplying division can earn profit, which will give motivation to the employees to work because based on the profit, they will be getting the bonus ultimately. Clear? Yes, this is cost based market, cost based transfer price. Next, we also have the market based transfer price. What do we have in market based transfer price? Firstly, what is the advantage? Firstly, it is unbiased. It's market price. It is what is happening in the market, what is prevailing in the market. I cannot bring in my own subjectivity biasness there. So it is generally unbiased because it is based on demand and supply. Yes, they are less ambiguous and cannot be manipulated. Cost I can manipulate the way I want. Okay, but market price I cannot manipulate. And thirdly, as pricing is competitive, divisional performance can be linked more objective. Yes, because pricing is competitive, it is based on what is happening in the market. So every division's performance will be more more realistic. Okay, this is the advantage. What is the disadvantage? Market price may be biased if competitive market doesn't exist. Suppose I'm selling a goods for which market only doesn't exist. Yes, then what do we do? Yes, market price may be biased. Whatever I tell will be the market price. I'm selling it to him at 100 rupees. Yes, that itself would be the market price because it is nowhere else available. Yes, it is not suitable if market price is fluctuating widely or quickly. Market price keeps fluctuating every now and then, and there is a big difference. Then this is not relevant. It will not be appropriate. Okay, and sometimes market price may not be available. Suppose if goods transferred are at an intermediate stage. Suppose to manufacture a pen, we are transferring this nib. Okay, this nib we are not selling outside anywhere. Nobody is selling outside nib on a standalone basis. They are only selling the pen. So market price itself will not be available. How do we use them? This becomes the disadvantage. Again, I am telling advantages, disadvantages. Firstly, they are not important from the examination perspective. Secondly, even if it comes in the examination, okay, rarest to rare case, still you guys can write it on your own. Do not worry too much about that. Okay, important areas are coming ahead. Yes. So what all methods we have? Firstly, we have the market price method. Here, market price of transfer itself will be treated as the market price. So we'll ask Android at what price you are giving it to others, to MI, Huawei, all those companies, at what price you are transferring. MI is telling I'm transferring at 3000. We'll tell internally also you transfer at 3000. End of the discussion, end of the discussion. Next two methods which we have is shared profit relative to total cost. Here what we are going to do. Here the total profit of the company we will distribute between the divisions in the ratio of the cost incurred. Yes, what we are going to do? First, we need to calculate transfer price, right? So we'll tell yes, transfer price. Before we calculate the transfer price, we want to know what is the cost in the transfer division, what is the profit of the transfer division. Yes, cost anyways, it is available in the records. We want to know how much profit to calculate, how much profit to charge. We'll tell, let us calculate the total profit of the company. And whatever is the total profit, that will distribute in the ratio of the cost. We'll understand it with the help of an example. Suppose cost. We have transferor division, transferee division. Transferor is incurring a variable cost of 1000 rupees, fixed cost of 500 rupees. transferee division is incurring other variable cost. Yes, 5,000 and fixed cost of 500. Final selling price is 10,000. So firstly, what all is the cost? In transferor division is telling my cost is 1,500 rupees. Transferee division is telling my cost is 5,000 plus 500. Yes, 5,500. Now we are looking at the perspective company. Firstly, we are telling company how much profit it will earn. We are telling company will ultimately sell the mobile, we will get 10,000 rupees. So 10,000 rupees is a revenue. Company, how much cost it is earning? Company, yes, company in division A, it is incurring an external cost of 1,500. In division B, it is incurring an external cost of 5,500. So company as a whole is incurring a cost of 7,000. Yes or no? So how much profit ultimately company is earning? Company is earning a profit of 3,000. So we are telling this 3,000 rupees, we will distribute it to division A, division B. How do we distribute? We want the ratio, right? We distribute in the ratio of the total cost. So we'll be telling total profit to the division. 3,000 rupees will distribute in the ratio 1,500 is to 5,500. So to division A, we will tell it is total profit 3,000 rupees we are distributing. Division A cost is 1,500. Total cost is 1,500 plus 5,500, 7,000. Division B will tell total profit is 3,000 rupees. Yes, in that division B cost was 5,500 divided by 7,000. How much is it, students? Is 642.85. 2357.14. Yes, so we'll tell to division A, ultimately don't worry, we will give you a profit of 642.85. To division B, ultimately you'll be earning a profit of 2357. Now division A is asking, so what will be my transfer price? We are telling division A, how much cost you have incurred. Division A, Android, how much cost you have incurred? It is telling I have incurred a variable cost of 1,000, fixed cost of 500. So total cost I have incurred is 1,500. We are telling yes, 1,500 is the cost that anyways you recover. Additionally, as a profit, you recover 642.85. We'll take it as 643. Yes, for rounding off. Yes, comes to 2,143. So we'll tell Android division transfer it at 2,001. Now what Android division is telling? Look at this. Android division is telling I'm getting 2,143. My cost is 1,500. My profit is 643. Here, ignore the rounding off. Now, division B, mobile division is telling I am selling the phone at 10,000 rupees. What all cost I am incurring? Externally, I am paying 5,500. Internally, for the transfer, I am paying 2,143. So, how much is the profit? I will earn 10,000 minus 5,500 minus 2,143 is 2,350. This is how we will arrive at the transfer price. Is it clear, students? So what we are doing, look at this. What are the steps we will follow? First, we will calculate what is the overall profit to the company. Company, how much profit is it earning? We'll tell for company how much is the sales, for company how much is the cost. We'll get the profit to the company. Step number one. Next, we are telling, yes, let us distribute this overall profit in the ratio of cost. We will tell, yes, what is the profit to each division? Is the total profit to the company multiplied by cost of the division divided by total cost of the company. So total profit we will distribute in the ratio of cost. Thirdly, we arrive at the transfer price. What is the transfer price? We tell the supplying division how much cost they've incurred. Yes, give that. They've given you a portion of profit. How much was that? Add that. Arrive at your transfer price. Is it clear, students? Should we continue? Yes, won't we get these notes? These notes will be uploaded on Telegram. Okay, don't worry. I just forgot to upload it before the class. Don't worry, at the end of the class, we will upload it. Okay, the complete written notes will also be given, and before the class handwriting, whatever is there before that, that will also be given. Don't worry on that. Okay. Yes. Next one we have shared contribution relative to variable cost. So market price, firstly we have told let us transfer it at market price. Next we have told shared profit relative to total cost. Yes, let us distribute that profit in the ratio of total cost. Here we are telling let us distribute the contribution in the ratio of variable cost. What we are doing, look at this. Same example, division A we have, division B we have. We are telling division A variable cost is 1000, fixed cost is 500. Division B other variable cost is 5000, fixed cost is 500. Final selling price is 10,000. Firstly, we tell company as a whole how much contribution it is earning. We are telling company how much revenue we are getting. Company ultimately we sell the phone, we get 10,000. Yes, what all variable cost company is incurring. Company, yes, we are telling in division A. Division A people have asked to pay 1000 rupees. So for them, I'm paying 1000 rupees externally. Division B people, they have asked for 5000 rupees. So overall, I'm incurring a variable cost of 6000 rupees. The total contribution I earn is 4000. Now we tell this 4000 contribution, distribute it to division A and B. So how do we distribute? Whatever is the ratio available, variable cost ratio is available, in that ratio you distribute. So what we are going to do? We are going to distribute 4000 in the ratio of 1000 is to 5000. That is 1 is to 5. Division A will tell 4000 is the total contribution of the company. Your portion is 1 by 6. Okay. Division B will tell 4000 is the overall contribution of the company. Your portion is 5 by 6. So how much it will come to? 666.66. Let's consider it as 667. 4000 into 5 by 6. 3333. Let us take. Yes, so we are telling 667. 3330. Now, division A is asking, what is my transfer price? Yes, we know the formula. Selling price minus variable cost is equal to contribution. Selling price or transfer price. If it is external customer, we tell it selling price. If it is internal customer, it is transfer price. Now we want to arrive at the transfer price. What do we do? Variable cost, we take it to the other side. So we tell selling price or transfer price is nothing but variable cost plus contribution. So we tell division A, yes, how much is the variable cost you've incurred? Division A is telling 1000 rupees. Okay, so you recover 1000. Again, as the contribution, yes, to recover your fixed cost as well as to earn your profit, we are giving you 667. So transfer the goods at 1667. This is the transfer. So this amount we transfer, we transfer at 1667. 1000 is our variable cost, 667 is our contribution. Yes, division B is telling I'm selling the phone at 10,000 rupees. My external variable cost is 5,000. Again, I have to pay to internal division 1667. So my contribution is 3330. Is it clear, students? Simple, very simple. Yes, the chance of being asked in the examination is less. You can put it in the B category, but if at all it comes for 5 marks, direct halwa, laddu. Okay, direct bonus questions for you. Okay, what do we do? Total contribution of the company is divided in the ratio of variable. So what are the steps? First, we calculate what is the total contribution to the company. Here we tell what is the sales from the perspective of company, how much we are getting, and company, how much we are paying. Forget internal, only from the perspective of company you see. You get the contribution of the company. Next, we need to distribute this contribution in the ratio of variable cost. Then what is the total contribution which has to be distributed into what is the variable cost of the division, what is the variable cost of the company. You get the respective contribution. And we arrive at transfer price, we've told. Yes, how do we arrive at transfer price? We ask, how much is the variable cost you've incurred? That anyways you recover. Over and above that, recover this contribution also from which you can recover your fixed cost and earn profit. Is this clear, students? Okay, so this is market based transfer pricing. First, we have looked at cost based transfer pricing. There we have looked at full cost, marginal cost, standard cost, cost plus markup. Second, we have looked at market based transfer pricing. Here we have looked at market price, shared profit relative to total cost, shared contribution relative to variable cost. Any doubt, students? Yes. Next, and the most important, we have negotiation based transfer. Here what we are going to do, transferor and transferee will negotiate and will arrive at a transfer. Yes, transferor and transferee will go, they will negotiate, they will arrive at a transfer price. So how do they do that? Yes, we have the next concept, which is transfer pricing range and the concept of goal congruence. We are telling transfer pricing range. Okay. In case of a negotiation based transfer pricing method, transferor and transferee will negotiate and arrive at a transfer price. So in such a scenario, transfer price range comes into being. Yes, when they are negotiating, they are thinking how much minimum we should be getting, how much maximum. Okay, what is the minimum, what is the maximum? That transfer pricing range they are thinking. How they think, what they do it, let us try to understand it. Okay, so we have negotiation based transfer pricing. Same example, we have Android division, which is a transferor, Google Pixel division, which is the transferee. So what is going to happen in negotiation based transfer pricing? We have transferor and transferee. We lock them up in a room. Yes or no? And tell, fight, negotiate, fight, throw chairs, throw pillows, whatever you want to, and come out with a transfer price. Yes or no? So they are locked in a room. What thing we remember when we get to know? Yes, they are locked in a room. You guys are getting music in the background. Yes or no, students? You guys are getting? Hum tum ek kamre mein band ho. Yes, that's what is going to happen. Yes. So what company is going to do? MD will call. Yes, transfer division, Android division, come here. Transferring mobile division, come here. Go sit. Yes, he will lock. Tell, fight, discuss, do whatever you want. Come out with the transfer. Okay. So they are going to negotiate and arrive at a transfer. Now, before you go for a fight, you do your warm up, you do your exercise. So you get ready for the fight. Now, transferor is getting ready. Transferor, Android. Yes, who is selling the goods? I'm selling the goods. I'm getting ready. Yes, I'm thinking. Yes, in a range, what I should keep in mind. Yes, he's thinking. Yes, what should be the minimum transfer price? I'm selling the goods. Yes or no? Yes, if I'm selling the goods or services, Android. Okay, I'm thinking, yes, to manufacture this. Okay, yes, to give one license, what all cost I'm incurring? I want the employees, I want the employee cost, and the development cost I need to distribute. All of that. Suppose for every Android license, the variable cost is, say, for example, 1,000 rupees. So Android person is telling, for every license, I'm incurring 1,000 rupees. So bare minimum, 1,000 rupees at least I should get. Lesser than that, I will not get. Okay, accept. Okay, so transferor is telling bare minimum, what is the marginal cost that I have incurred? That at least I should get. So transferor is telling, yes, he will keep in mind what is the minimum amount. Yes, 1,000 rupees have incurred, 1,000 at least I should get. That will be there in his mind. But whether the transferor will think about the maximum transfer price, whether the transferor will think, yes, he's going into negotiation, he's thinking, yes, maximum I'll charge 2,000. More than that, even if transfer is telling I will give, no, I will not take. I cannot do that. Maximum I'll charge 2,000 only. More than that, even if he gives me, I will tell no. Yes. Will he think that way? Yes or no? Will he think that way? No, he will not think. What transferor is thinking? Transferor is thinking minimum this much I should get. More than that, whatever I get is bonus. Yes, I will fight to get maximum, but minimum at least this much I should get. So transferor will always keep in mind the minimum transfer price. Transferor will always keep in mind the minimum transfer. Before he is going into the negotiation, before he is going into the fight, he keeps in mind 1,000 rupees I have incurred. So at least 1,000 rupees I need to get. More than that, whatever, we will negotiate and fight and see. Now, transferee is there. Whether transferee will keep in mind what is the minimum amount he will pay, he will pay. Yes, whether transferee will think. Okay, first transferee will think about the maximum transfer price. Transferee is telling the maximum I can pay only 3,000 rupees. Yes or no? That might be there in his mind. He's telling maximum I have with me 3,000 only. So maximum I can pay 3,000 rupees. Maximum outside other supplier is giving to me at 3,000. So maximum I will pay 3,000 rupees only. More than that I cannot pay. That will be there in the transferee's mind. Yes or no? You are going into a shop to purchase something. You will think maximum for a shirt 1,000 rupees I will pay. More than that I will not pay. But do you think minimum? Yes, whether transferee is thinking minimum I will pay at least 2,000 to him. If he is giving lesser than that, I cannot accept. Check. I have business ethics and all. Minimum I'll pay him at least 2,000 rupees. Yes, even if transferee is giving me at 1,500, I'll tell no, 2,000 at least I will give. That way, whether transferee will think no, right? Yes. So transferor will not think about the maximum transfer price, that he will negotiate. Transferee will not think about the minimum transfer price, that he will negotiate. What transferee keeps in mind? He keeps in mind the maximum transfer price. He tells how much maximum I can pay. This is what transferee keeps in mind. So yes, while we are entering into a negotiation, transferor is keeping in his mind, yes, my variable cost is 1000, I need to at least get 1000. Transferee is keeping in his mind, outside I will get it at 3000, so maximum I can pay 3000, more than that you cannot. Yes, now they fight, they argue, they discuss, and ultimately they come to a transfer price telling. Say for example, they're telling, okay, 2275 will be the transfer price, or whatever is the transfer. What we need to do, we need to give them the transfer pricing range. So what we are telling in transfer pricing range is how much is the minimum transfer price, how much is the maximum transfer price. So when we are telling minimum transfer price, from whose perspective we are telling students? Minimum, how much minimum I should get? Transfer is telling. When we are telling maximum transfer price, from whose perspective we are telling students? How much maximum I can pay? We are telling from the perspective of transferee. So when we are telling transfer pricing range is minimum transfer price to maximum transfer price, where minimum transfer price is from the perspective of transferor, maximum transfer price is from the perspective of transferee. Is it clear, students? So in a negotiation, transferor will keep in mind the minimum transfer price. He'll keep in mind this, at least this much I have income, but this much at least I should get. Transferee, what transferee will keep in mind? He will keep in mind the maximum transfer price which he is ready to incur. He will tell maximum I can incur only 3000 rupees. Yes, he will keep in mind that thing. And how do we arrive at the transfer price range? Range is nothing but minimum to maximum, minimum transfer price to maximum transfer price. So when we are telling minimum transfer price, it is from the perspective of transferor. And when we are telling maximum transfer price, it is from the perspective of transferee. Is it clear, students? So how do we arrive at a transfer pricing range? Transfer pricing range is minimum transfer price to maximum transfer price, where minimum transfer price is from the perspective of transferor, maximum transfer price will be from the perspective of transferee. Clear? Now we are thinking about the minimum transfer price. What is happening in transferor's mind? Okay, we'll give you another example. Yes, about the transfer pricing range. Suppose your mom is going, okay, yes, mom or a random lady, okay, is going to purchase vegetables. Okay, we are going to purchase vegetables. What will be there in mom's mind? Yes, mom will think, yes, mom is going to purchase apple. He'll think, maximum I can pay 100 rupees for apple. More than that, he cannot pay. So customer is always thinking, maximum this much I can get. Lesser than that, 80, 70, 60, even if he is giving for 10 rupees, he'll take and come. Supplier, yes, the shop vendor, he is thinking minimum for apple, to purchase apple only I have incurred 60 rupees. Minimum 60 at least I should get. Yes, more than that, whatever, yes, based on negotiation. If she is willing to give me 100 rupees, I'll take 100 rupees and keep it. Okay, based on that, they will going to negotiate. Now, minimum transfer price from the perspective of transfer. What transferor is telling? Transferor is saying minimum. How much cost I have incurred specifically for this? That much at least I should get. More than that, we will negotiate and see. But at least whatever is the cost I've incurred specifically for this I should get. So what is transferor telling? Whatever is my marginal cost, this at least I should get. At least give me the marginal cost. Lesser than that, you cannot accept. So minimum transfer price from the perspective of transferor is the marginal cost of the transferor. Transferor is telling, for every transfer, I am incurring a marginal cost of 1000 rupees. So you need to give me at least 1000 rupees. Lesser than that, there is no way I will accept it. Yes. And what all we have in marginal cost? Sorry. So what all we have in marginal cost? In marginal cost, we have variable cost, specific fixed cost, and opportunity cost. So what is the minimum transfer price, students, from the perspective of transferor? Transferor is telling at least bare minimum I should be getting my marginal cost. What all we have in marginal cost? Variable cost, specific fixed cost, and opportunity cost. Now, while calculating the cost, variable cost, if there is any variable cost which is not incurred for internal transfer, say for example selling and distribution overheads, it can be ignored. Question is telling yes, this is the cost we are generally incurring, but for internal transfer it is not there. Suppose we are telling yes, packing, okay, beautifully we pack for external customers, but for internal transfer we don't do that, so that cost will ignore. Clear? Yes, that is how we arrive at yes, for this internal transfer what is the marginal. Clear? Now maximum transfer price from the perspective of transferee. Transfer is saying maximum how much I can pay. Yes, there are two ways in which he is thinking, and he is telling maximum how much amount I am willing to pay you. Look at this maximum transfer price for transferee. Is he's telling what is the external buy-in price, outside at what price I'm getting, or net marginal revenue, net how much cash I'm having. Based on that, I'm going to decide. What is it? How we are going to decide? Look at this. Now we have Android division transferer. Yes, we have transferee, that is mobile manufacturing division. We ask the transferee how much maximum you are willing to pay. Yes, he's telling, look at this. Outside, okay, if I don't have Android, what I'll do, there is another software called Zendroid. Same features, more or less same features, which is available for 3,000 rupees. Okay, and because it is not that good quality, I need to make a bit of alteration. For that, I've kept an employee for which I'll be incurring 500. So if I'm getting it from outside, how much I'll be incurring? To Zendroid, I'll be paying 3,000. For alteration, I'll be paying 500. So I'll be paying total 3,500. He's telling maximum to Android, I can pay 3,500. Nothing more than that. Yes, so what is the maximum transfer price? I'm telling to outside person how much I'm paying, that much amount only maximum I can give it here. What is my external buying cost? That amount only I can give it here. So maximum transfer price, the transfer is telling it is the external buying cost. That is one perspective. Then telling how much outside I can pay, how much outside I am paying. Next, it is the net marginal revenue. What do you mean by net marginal revenue? We ask the transferee, mobile division. Okay, forget all of that. How much extra revenue you get? Okay, yes, how much extra revenue you get? So this person is telling, yes, how much extra cash you have in hand. This person is telling, look at this. Yes, if I sell my phone, I'll be getting 10,000 rupees. Okay, if I sell my phone, I got 10,000. In this, I need to incur all my cost. Yes. So what other variable cost I'm incurring? I want screen, display, RAM, etc. For that, I'm paying 6,000. Okay, so I will get 10,000 if I sell the phone. 6,000 I have paid. Now net cash, how much is there? 4,000 is there. Maximum I can pay 4,000 for the Android. This is the net marginal revenue I am having in my hand. Is it clear, students? Net marginal revenue means net how much cash I have in my hand. How much maximum cash I am having because of this? That much maximum I can give. Ignoring that, yes, given the fact that I am telling, okay, I don't want profit. I don't want profit, but I don't want loss also. How much maximum I can pay? Yes, so maximum I can pay you extra for Android. Maximum I can pay you 4,000. Yes, this way I will reject no profit. No. If I pay you more than that, if I pay you 5,000, I will be incurring loss. This is what transfer is telling. Look what transfer is telling. Transfer is telling, see, by selling a mobile, I will be getting 10,000 rupees. So I got 10,000. But to manufacture, I need to pay 6,000 rupees. So net how much cash is available with me now? 4,000 is available with me now. Maximum I can pay you 4,000. That is the net marginal revenue. Is it clear, students? So we have two different things to be kept in mind while we are talking about the maximum transfer price. First, we have the external buy-in price. If we are buying from outside, how much cost we will incur? Look at this external buying cost. Outside, how much cost we are incurring? Yes, net marginal revenue. With us, how much cash is there? Whichever is lower. Why whichever is lower? We will discuss it. Now, what all we have in external buying price? We'll tell external purchase cost. If you are buying from outside, how much cost we are paying? To Zendroid, we are paying 3,000. Plus or minus alteration cost. If we have any alteration cost, how much is it? Yes, based on that, we get the external buying cost. Suppose I am telling, if I buy from Zendroid, I will pay 3,000 rupees for alteration. Again, I am paying 500 rupees. So here I will be paying 3,500. So to Android maximum, I can pay 3,000. Next, we have net marginal revenue. How much extra revenue is there with me? We are looking at the marginal revenue. We will be considering only the relevant. Because of this transfer, how much we are getting. Because of this sale, how much we are getting. So fixed cost, general cost, we will ignore. We are telling how much is the final selling price. ultimately the transferee, mobile, how much selling price you will get? 10,000 will get. In this 10,000, 6,000 we need to pay to other variable cost, all other costs, screen, etc. So how much maximum cash you have? 4,000. Maximum I can pay you 4,000. More than that, I don't have the ability to. Minus other variable cost, you will arrive at the net marginal. Is it clear, students? Maximum transfer price. We are looking from outside, what is it? From inside, what is it? Outside perspective. I'm telling, yes, if I buy from outside, what is my cost? External buying cost. Inside, how much net cash is there with me inside? So I'm telling net, what is the final selling price minus what is the other variable cost? Net cash, how much I have. Yes, whichever is lower. Why whichever is lower? Look at this. I'm giving you three cases. First, I have external buying price, net marginal revenue. Tell me which is the maximum transfer price. Android division is willing to tell. Android division, in first case, Android division is telling, see boss, if I'm getting it from outside, okay, I will get it at 3,000 rupees. Okay, and the net marginal revenue, net cash that I have with me is 4,000 rupees. So maximum how much I am willing to pay? Yes, how much mobile division is willing to pay? Mobile division is willing to pay only 3,000. Mobile division is telling, see, for 3,000 rupees, I'll get it from outside. Maximum I can pay you 3,000. More than that, I won't pay. Yes, but 4,000, yes, I won't profit. Yes, if you don't give me, I will buy it from other supplier at 3,000 rupees. So I'll give you 3,000 only. So maximum mobile is willing to pay is 3,000. Is whichever is low. Second case, okay, it is telling, see, 5,000 is the external buying price. 4,000 is the net margin revenue. Yes, mobile division is telling, see, if I buy it from outside, it is 5,000 rupees. Net cash I have with me is 4,000 only. Yes, anyways, I was thinking, yes, let me not manufacture only. Why? Because I don't have sufficient cash. If I'm getting it from outside, 5,000 rupees it was. I was thinking, yes, let's not manufacture this only. But because you are there, if you give it to me at 4,000, I will sell. Yes, I will not earn profit, but I will not incur loss also. But more than 4,000 if I pay, I will go under loss. So maximum I can pay you is 4,000 only, whichever is lower, 4,000. Third case, external buying price is also 4,000, net marginal revenue is also 4,000. So we'll tell whichever is low. Is it clear, students? This is the most important concept. Almost 90% of the times in the examination, if a question comes, it is based on minimum and maximum transfer price. What is the minimum transfer price? Firstly, yes, transfer pricing range. We need to tell the minimum, maximum transfer price. Minimum transfer price from the perspective of transfer, maximum transfer price from the perspective of transfer. How do we arrive at the minimum transfer price? Yes, it is the marginal cost. How much extra cost transfer is incurring? Variable cost, specific fixed cost, opportunity cost. Yes, how much maximum transfer is willing to pay is the external buying cost. If I'm buying from outside, how much it is? Or net marginal revenue, how much cash I have with me, whichever is lower. External buying cost is external purchase cost plus or minus alteration. Net marginal revenue is the final selling price minus other variable cost. Is it clear, students? Should we continue? Yes, let's get it with the help of an example. Suppose we have a company has two divisions, transferor division and transferee division. Division A, transferor division, which manufactures a component whose name is alpha, which is required by transferee division. Okay, we are manufacturing a component which is required here. What is the variable cost? 70 rupees. Selling price is 135. Maximum, how much units we are in a position to produce? 5,000 units transferor is in a position to produce. Now, division B uses alpha and produces finished goods beta. Okay. For every finished goods beta, 1 unit of alpha is required. Manufacture 1 beta, 1 alpha is required. Like this, how many units of beta we are planning to manufacture? We are planning to manufacture 1,000 units of beta. So how much units of alpha is required? 1,000 units of alpha is required. So 1,000 units of alpha we need to transfer. You have to calculate what is the minimum, what is the maximum transfer. Other details of beta, it is telling selling price of beta is 250. Other variable cost you have to incur is 65. Yes, again question is telling we can also buy alpha from external market at 120 rupees. But yes, if we are buying it from external market, we need to do some alteration which will cost 10 rupees. Okay, which is not required if we purchase from division A. Now, calculate minimum and maximum transfer price. If external demand of alpha is 4,000, 4,500, 5,000. So let us look at this. First, let us calculate the minimum transfer price. How much minimum division A wants? Three different scenarios are there. We are telling our capacity, how much maximum we can produce is 5,000. External demand, how much we are having? First case 4,000, 4,500 and 5,000. Now spare capacity. In first case, look at this. I have a capacity of 5,000. Right now I am fulfilling 4,000. So 1,000 units spare capacity I have. Okay. So if at all division B wants 1,000 units, I can give 1,000 units from my spare capacity. Yes or no? Spare capacity. Now in the second case, look at this. 5,000 units is my capacity. Maximum 5,000 I can produce. Right now 4,500 I am producing. Spare capacity I have is only 500 units. So if at all I have to provide 1,000 units to division B, what I need to do? 500 units I can give from my spare capacity. But balance 500 units, what I need to do? I need to sacrifice my external demand. Yes, I need to tell a customer who has ordered for 500 units. Yes, a customer came, he is asking for 500 units. I'm telling, sorry, I cannot give you. Because maximum internal I will be in a position to sell 1,000. External maximum I will be in a position to sell 4,000. So 500 units I need to sacrifice. Suppose my capacity is 5,000. At present, I'm selling 5,000. There is no spare capacity at all. If at all I need to make an internal transfer, I need to sacrifice all 1,000 units. I need to sacrifice. Is it clear, students? Now, let us calculate the minimum transfer price. What is the minimum transfer price? Is variable cost plus specific fixed cost plus opportunity cost. Now, first case, if I have 1,000 units spare capacity, I'll tell what is my minimum transfer price. Yes. Am I sacrificing anything? No. I had 1,000 units spare capacity, from that I gave. I'm not sacrificing anything. So there is no opportunity cost. Specific fixed cost is also not there. What is my variable cost, students? Variable cost is 70. Therefore, the transfer price will also be 70 rupees. Clear? So in the first case, minimum transfer price is 70. Second case, I'm telling 500 units spare capacity is there, but for balance 500 units, I'm sacrificing my external sales. I'll tell total how many units we are selling? 1,000 units. So what is the total variable cost? I'll tell 70 rupees per unit into 1,000 units. So how much is the total variable cost? 70 into 1,000, 70,000 total variable cost I'm incurring. Do I have any specific fixed cost? No. What is the opportunity cost? Yes, for 500 units. Yes, on 500 units, external sale I am sacrificing. So I'm telling on these 500 units, how much contribution I could have earned, I will recover it from you. How much contribution I could have earned, students? Look at this. Variable cost is 70, selling price is 135. So what is the contribution, students? 135 minus 70, 65 I could have earned from every unit. Like this 500 units I had. So how much contribution I sacrificed? I'm telling 500 into 65, 32,500 I sacrificed because I'm making this internal transfer. This 32,500 also I will recover from you. So total how much we will recover? 70 plus 32,500. 1,02,500 total we will recover from 1,000 units. So per unit it will be 1,02,500 divided by 1,000 will be 102.5. Okay, so in the second case it is 102.5. Third case, all 1,000 units I am sacrificing. I'll tell, yes, what is the minimum transfer price? For every unit I am incurring a variable cost of 70. Specific fixed cost is not there. For every unit I am sacrificing my external sale. I could have earned 65 rupees outside, which I'm not earning. So for every unit, if you want, you have to give me 135. Otherwise, I will not give you. Because there is an external customer ready for 1,000 units. There is an external customer who is ready for 1,000 units who will give me 135, in which I will get 65 contribution. If I'm transferring here also, I want 65 contribution. The minimum transfer price will be 135 rupees. The third case. Okay, so minimum transfer price in all the three cases, we have three different minimum transfer price. But maximum transfer price, yes, maximum transfer price, we are looking at it from the perspective of transferring. Minimum, we are looking at it from the perspective of transfer. It depends on the spare capacity, yes or no? Transfer is thinking I have spare capacity, okay, at variable cost only I'll transfer. He's thinking no, I don't have spare capacity, okay, he will add the opportunity cost and transfer. But whether transfer is concerned, transfer is ultimately concerned with how much goods he's getting. Whether transferer has spare capacity, doesn't have spare capacity, transfer is least bothered. What is he bothered? Outside what price I will get? Yes, how much cash I have. Only two things he is bothered. Outside what price I'll get, how much cash I have. Yes, so in all the three cases, maximum transfer price will be same. Yes, transfer is telling external buy-in price. Yes, if I'm buying from outside, what is the cost? Transfer is telling, see, if I'm buying from outside, I will purchase it at 120 rupees. So I'll pay 120 rupees to the supplier. Again, I need to do some alteration for which I will be paying 10 rupees. So total, if I'm buying from outside, I would have incurred 120, 10, 130 rupees. So maximum for you, I can give 130 rupees. Yes, whatever amount I was giving outside, I'll give it to you 130 rupees. I will give it. Next, net marginal revenue. Yes, what is transfer telling? By selling this, I will buy the component from you. I'll buy alpha from you. By buying alpha, what I'll do, I have to incur extra variable cost of 65 so that I will arrive at a selling price of 250 rupees. So how much net cash I'll be having? Ultimately, if I sell, I get 250. Other variable cost 65 I need to pay. So how much I will be having in cash? 250 minus 65, 185 I'll be having. So the other restriction is I'll tell maximum 185 I'll be in a position to pay. Final selling price 250 minus other variable cost 65, 185, and we'll be taking whichever is lower. Transfer is telling yes. If you are giving it to me at 130, give it to me. More than that, yes, don't expect because I will buy it from outside supplier at 130 rupees. Is it clear, students? Clear how do we arrive at minimum and maximum transfer price? Should we continue, students? Now, so what will be the transfer pricing range? Okay, in the first case, okay, transfer minimum was 70, maximum was 130. Second case, minimum was 102.5, maximum was 130. Third case, minimum was 135, maximum was 130. So how will be the transfer pricing range? First case is 70 to 130. Second case, it is 102.5 to 130. Third case, it is 135 to 130. Is this a range, students? Is this a range? Whether a range like this is possible? Yes. Range means minimum to maximum. But what is there? We are telling minimum transfer price is 135. Maximum is 130. So whether transfer could be possible here? Yes, whether transfer is possible. Transfer is telling minimum I want 135. Transfer is telling maximum I can pay 130 only, or else I'll buy from outside. Whether transfer is possible here? Transfer is not possible here. Transfer should not happen here. Okay, in the first two cases, transfer can happen. Transfer is telling yes, I want at least 70. Transfer is telling maximum I can pay 130. So in between that, they will negotiate and they'll arrive at a transfer. Second case, transfer is telling minimum I want 102.5. Transfer is telling maximum I can pay 130. In between that, they'll negotiate and arrive at transfer. But third case, transfer is telling I have full demand, so I'm selling at 135. Minimum I want 135. Transfer is telling yes, I get it from outside at 130. So more than 130, yes, एक पैसा भी extra नहीं दूंगा मैं. So how will they arrive at a transfer price? They will not arrive at a transfer price. So in the third case, transfer will not be possible. So in the first and second case, transfer pricing range is possible. So transfer should take place. Ideally for the company, transfer should take place. If transfer take place, it will be beneficial for company. But in the third case, transfer pricing range is not possible. So ideally, transfer should not take place. Transfer does not take place, it would be beneficial for company. Yes or no? Look at it from the perspective of company. Yes, company is telling in the first case, okay, I want 1 unit of raw material. Yes, how much cost the company is incurring? Yes, if company manufactures on its own, company is saying I'll be incurring 70 rupees only. But if he buys from outside, yes or no, he'll be incurring 130 rupees. So if we manufacture on our own, 70 rupees. If we buy from outside, 130 rupees. If we does on our own, if we manufacture on our own, we'll be in a position to save 60 rupees, maximum minus minimum. Second case, we are telling, if we do it on our own, we'll be incurring 102.5. Yes, variable cost plus opportunity cost. If he buys from outside, 130 rupees. So still, if we do it on our own, we'll be in a position to save 27.5. But in the third case, look at this. What is happening? Transferer, I have full supply now. I have full supply. Yes, customer is willing to pay me 135. Okay, yes. for my transferee, he is getting the goods at 130. So if we make the transfer possible, it is not beneficial for company. What company is telling? Yes. Transferer, you sell it at 135. So we get 135 cash. Transferee, you buy it at 130. So you pay 130. So net 5 rupees benefit we have if transfer does not take place. Yes or no? If transfer takes place, this benefit will not be there. If we tell, yes, we tell both of them. You sell it outside, you buy it outside. Transferor we tell, yes, you sell it outside. At what price you are selling? 135. So transferor gets 135. Transferee, we ask him, go buy it outside. Yes, he will get it at 130 rupees. So 130 he'll pay. Net 5 rupees will be there with us if transfer does not take place. So what is the conclusion, students? If transfer pricing range exists, that range is possible, then ideally for the company, transfer should take place. But if the range does not exist, in the third case, 135 to 130, ideally for the company, transfer should not take place. Is it clear, students? Yes, should we continue? Now, what is the profit or loss to company as a whole if transfer takes place or transfer does not take place? We've told you is the maximum transfer price minus the minimum transfer price into number of units. Yes, look at this. In the first case, we are telling, yes, how much benefit we will happen if transfer takes place. Look at this. If he is buying from outside, okay, if customer is transfer is buying from outside, he has to pay 130 rupees. But if internal transfer is happening, okay, for internal transfer, how much cost we need to pay? 70 only. So how much we can save? 60 rupees we can save. It is maximum transfer price minus minimum transfer price. 60 rupees we can save for 1 unit. Like this, if you are selling 1000 units, 60 into 1000, 60,000 we can save. Third case, see this. How much we can save? Yes, maximum minus minimum. Just take the number. Just take the difference. Do not go specifically telling which is maximum, which is minimum. 135 minus 130. 5 rupees we can save if transfer does not take place. Yes or no? If transfer does not take place, yes. Transferor will sell at 135, he will get 135. Transferee will buy at 130, he will pay 135 rupees. Net is there. But if transfer is taking place, ultimately it is happening within the organization. No cash will be left. So 5 rupees we can save if transfer does not take place. So what is the profit or loss? It is maximum transfer price minus minimum transfer price into number of units transferred. So look at the scenarios, what all is possible. First, if transfer pricing range exists, that is, suppose transfer pricing range is 70 to 130. Second, if transfer pricing range does not exist, that is, suppose 135 to 130. Transfer pricing range exists. Two decisions could be possible. Yes, actually transfer has taken place. Actually transfer has not taken place. Again, transfer pricing range does not exist, but still transfer has taken place. Still transfer did not take place. Now, which is from the perspective of company, transfer pricing range exists. So ideally for company, transfer should take place. Transfer takes place, it is profit for the company. 70 to 130. Yes, company is telling if you buy from outside, we need to pay 130. But if you are doing it in house, it is 70 rupees only. So ideally, we should be doing it in house. But if the range exists, still we do not make the transfer. How much we are losing? Yes, we are losing 130 minus 70, 60 rupees. If transfer pricing range exists, still transfer does not take place. It is loss for the company as a whole. Okay. Yes. So if transfer price range exists 70 to 130, if you are doing it in house, our cost is 70. But if you are buying it from outside, it is 130. Till we decided we will buy it from outside. Company as a whole, 60 rupees extra it is incurring. So 60 rupees is loss for company. Second, transfer pricing range does not exist. Range is not existing. So ideally, we should not be transferring the goods. If we do not transfer, it is profitable for us. But despite range not existing, if we transfer, it will be the loss. How much is the profit or loss? The monetary amount is maximum transfer price minus minimum transfer price into number of units transferred. Is it clear, students? Yes, this is again very important. Should we continue? Now, concept of goal congruence, yes or no? Yes, concept of goal congruence. I told that when is it, when the goals are congruent, when both the divisions are taking the same, yes, are having the same goals. Now look at this. What is goal congruence? It is a situation where goals or decisions of both divisions and company is the same. Suppose division is also taking a decision, company also wanted you to take the same decision, then you will tell the goals are congruent. Company also wanted you to take the decision, you have also taken the same decision. But if company wants you to take one decision, you are taking other decision, we are telling goals are not congruent. Now look at this. Same scenario, we are telling transfer pricing range exists, range does not exist. Yes, range exists, transfer takes place. Range exists, transfer does not take place. Range does not exist, transfer takes place. Range does not exist, transfer does not take place. Yes, ideally, yes, if transfer pricing range exists, what company wants? Company wants that transfer should take place. And in actual, if transfer takes place, company also is telling transfer should take place. Division are also making the transfer. We are telling goals are congruent. But range exists. Company is telling transfer should take place, but division is not making the transfer. We tell goals are not congruent. Range does not exist. What are we telling? What company is telling transfer should not take place? In actual, transfer did not take place. We are telling goals are congruent. Company also told don't do transfer. Division also didn't do the transfer. But company told don't do the transfer. Still divisions did the transfer. We are telling goals are not congruent. This is the actual meaning of goal congruence. Okay, everywhere in theory answer, everywhere in analysis, we'll be using this term goal congruence. What is goal congruence? It is the situation wherein goals or decisions of both divisions and company is the same. Company is telling transfer, divisions are also transferring. Company is telling don't transfer, divisions are also not transferring. That time we'll tell the goals are congruent. Otherwise, we'll tell the goals are not congruent. Is it clear, students? With this, we've finished negotiation based transfer price. Again, I'll revise. Yes, in negotiation based transfer price, we have the transfer pricing range, that is minimum to maximum transfer price. Minimum is from the perspective of transferer. It is the marginal cost, how much marginal cost you have incurred. Maximum, it is from the perspective of transferee. It is external buy-in cost or net marginal revenue, whichever is lower. What is the external buy-in cost? It is external purchase price plus or minus alteration cost. What is the net marginal revenue? How much cash I have in me? Final selling price minus other variable cost. Clear, students? Should we begin solving the questions? Everyone, are you guys ready? So we've done two concepts almost. From the perspective of concepts, everything is over. Only little things are pending. So from the perspective of questions, let us have a look at this. Okay. Concept 1, methods of transfer pricing. There are no questions. I've told it is not very important from the perspective of examination. Yes, transfer pricing range and the concept of goal congruence. There are no illustrations, but test your knowledge question number 1 to 8. All these are based on this concept. Okay, so it is important. We'll have a look at this. Test your knowledge question number 1. It is very simple, very basic. We'll do it. You guys can do it on your own. There is nothing I need to explain. Test your knowledge question number 2 is again a good question, but we'll do it at the end. We'll start from question number 3. This question number 3, page 8.34. Centurion Company. It operates a pulp division that manufactures wooden pulp. Okay, all the data is given. Centurion Company has just acquired a small company. Yes, company has just acquired a small company that manufactures paper cartons. This company will be treated as a division with full profit responsibility. Yes, newly formed carton division is currently purchasing pulp every year from a supplier at a rate of 210 minus 10% discount. Okay, Centurion's president is anxious that the carton division begins purchasing its pulp from the pulp division if an acceptable transfer pricing can be worked out. What is the question telling? Look at this. A Centurion, we have two divisions. Okay, firstly we have the pulp division. Again we have the carton division. Okay, carton division is a company which we have recently acquired. At present, what is carton division doing? It is buying from outside supplier at 210 rupees minus 10% discount. What is the president telling? Yes, pulp no you want. You have the pulp division only no. If possible, why don't you get 10,000 kg pulp from within? What we need to see? Okay, three situations are there. In the three situations, first situation, if pulp division is in a position to sell all of its pulp to outside customers at the normal selling price of 210 rupees, will the managers agree to transfer at a determined price? Explain with reasons. What is the first case we are telling? Yes, first case we are telling transferor. Pulp division is operating at full capacity. So what pulp division is telling? Yes, pulp division is telling. Yes. What is the variable cost I am incurring? Pulp division is telling, yes, pulp division details is given. What is the variable cost pulp division is getting? 126. Again, I am operating at 100% capacity. So if I am making any internal transfer, I need to sacrifice my external sales. How much contribution I am losing? Yes, contribution given there is 84 rupees. So I'll tell how much minimum I want. 210 rupees minimum I want. Yes, pulp division is telling. I'm selling it outside at 210 rupees. I'm getting 84 rupees now. Even if I make an internal transfer, I want 84 rupees. I want a transfer price of 210 rupees. So minimum transfer price, yes, he's telling is 210 rupees. Now, what is the maximum transfer price? How much maximum the other division is willing to pay? Look at this. What is the division? Division can purchase it at 210 minus 10 percentage discount. Yes or no? It is available at 210 rupees minus 10 percentage discount. So how much is it, students? 189 rupees. How much is the net marginal revenue? Whether net marginal revenue details is given, net marginal revenue details is not given. Yes or no? So if it is not given, we will not consider it. This is not available. So what will be the maximum amount transferee is willing to pay? Transferee will be willing to pay 189 rupees only. Yes or no? So transferee is telling minimum I want 210. Transfer is saying maximum I can give 189. Yes, at 189 I'm getting it from outside. Maximum I can give you 189. So whether transfer can take place, students? Whether transfer can take place? Tell me, students. Yes, whether transfer can take place? No, transfer cannot take place. The transfer pricing range doesn't exist. Yes or no? Yes, transferor is telling minimum 210 I want. Transfer is telling maximum 189 I want. So transfer should not take place. Ideally, what company should tell? It's transfer, you sell outside, you get 210 rupees. Transfer, you buy from outside, yes, take 189 from here. For every unit, you'll be earning how much? 210 minus 189. Yes, 21 rupees you'll be earning if transfer did not take place. Okay, yes. So what we are telling, Carlton is not willing to pay more than 189 rupees. Carlton division will not pay more than 189 rupees. Okay, and pulp division will not sell for less than 210 rupees. So transfer will not take place. So there will be no mutually agreeable transfer price. So no transfer will take place. So even though they discuss, they talk, they fight, they throw chairs, whatever they do, transfer cannot take place. Clear? That is the first scenario. Is it clear, students? Tell me. Now, second scenario, what is the question telling in the second scenario? Assuming that pulp division is currently selling only 60,000 kg at 210 rupees, will the manager agree? Yes, what is our capacity? My capacity is 1 lakh. Look at this, based on a capacity of 1 lakh kg. My capacity is 1 lakh. At present, I'm selling outside 60,000 only. So I still have a spare capacity of 40,000. So in this 40,000, I have to transfer just 10,000 kg, right? So I'll tell, okay, I have no contribution loss. Yes or no? Yes, maximum. If I sell outside 60,000, I'll sell. Yes, 10,000, I'll sell. Still, I'll be selling totally 70,000 only. I'm not sacrificing any external sale. So I'll tell how much minimum I want. Yes, give me my variable cost. That is sufficient. I'm not having any opportunity cost, no specific fixed cost. What is my variable cost? 126. Give me 126 is sufficient. Now, what is the transfer telling? Yes, how much maximum externally, how much it is available for 182, 10 minus 10 percentage. 189 net marginal revenue is not available. So transferee will tell maximum I can pay you 189. So transfer price range is there, is 126 to 189. So whether transfer should take place? Ideally, transfer should take place. If transfer takes place, how much is the gain, students? On every unit, 189 minus 126. 63 rupees is the benefit per unit. Like this, we have 10,000 kg per kg. Yes, 63 into 10,000. Yes, 6,30,000 will be the benefit if transfer takes place. Yes or no? Otherwise, what was happening? I was buying from outside at the rate 189 into 10,000 kg. Now, to manufacture, I'll be incurring only 126 into 10,000 kg. Balance 63 into 10,000 kg will be the savings I will be having. What analysis we are telling? We are telling that transfer price range exists. So ideally, from the perspective of business, transfer should happen. Okay, so we are telling if managers are cooperative and they understand the business, so transfer should take place. And if transfer takes place, what is the benefit we'll be getting? It is 62 rupees per unit into 10,000 kg. 6.3 lakh will be the benefit we will be. Is it clear, students? We have the third case now. Yes. If the outside supplier of carton division reduces its price to 177, will pulp division meet its price? If the pulp division does not meet the price, what will be the effects on profits of company as a whole? Tell the consequence. Okay. Now we are telling, yes, till now we were telling pulp carton was purchasing it at 210 minus 10% discount. Now we are telling, yes, supplier is giving even more discount. Supplier is telling, yes, outside supplier is saying, you give me 177 rupees, it is sufficient. Now what company should do? Whether internal transfer should happen or else we need to buy it from outside. Here, this question has to be solved based on an assumption. What is the assumption? This question has not told in the third case what is the transference capacity. So how much external sales we are doing. So we'll make an assumption that in the second question we have assumed that external demand is 60,000 units. So now also we'll assume that external demand is 60,000 units. So based on that we'll give the answer. Yeah, otherwise our answer will not match the institute answer. So what is the minimum transfer price? We are telling 40,000 units spare capacity we have. So opportunity cost is 0. So my variable cost itself is my minimum transfer price. Minimum at least 126 I should get. Maximum how much transfer is willing to pay? Yes, outside it is available at 177. Net marginal revenue is not available. The transfer is willing to pay maximum 177. So transfer pricing range is 126 to 177 rupees. So ideally, transfer should happen. If transfer happens, what is the benefit? Look at this. If he is buying from outside, he needs to pay 177. But if we are doing it as a company, we need to pay 126 only. So how much we can save, students? 177 minus 126 is 51 per unit into 10,000 kg. 5 lakh 10,000 rupees we can save. So what is the analysis? Firstly, we are telling transfer pricing range exists. So transfer should ideally take place. So from the perspective of company, transfer should take place. Yes. But what is the issue we are having is, if you see the pulp division, okay, in pulp division, look at this, variable cost is 126, fixed cost is 54. So if you see the total cost comes to 180 rupees. So pulp division manager will be slightly apprehensive. He'll be thinking, my full cost is 180. I need to transfer at 177. Not earning, I'll not be earning profit. Forget that. I'll not be in a position to recover my full cost also. Yes. So this is what pulp division manager might be thinking. But what we need to remind him is that if this transfer is happening, okay, suppose at 177, he's at least getting 126 minus 177, 51 rupees towards his fixed cost. Otherwise, he will not even get 51 rupees towards his fixed cost. Fixed cost is anyways incurred. Okay, now because the transfer is happening, some portion of fixed cost he can absorb. But if this does not happen, he will not be in a position to absorb his fixed cost at all. So we are telling, see, spare capacity is there, so fixed cost will be irrelevant. Yes, and pulp division is in a position to recover most of its fixed cost, which would not have happened if transfer did not take place. So pulp division should be positive, should be willing to transfer it at the transfer pricing range. That was one behavioral thing which we have told. Next, we have told what is the overall impact on the profit. We have told what is the overall impact. It is maximum transfer price minus minimum transfer price, 177 minus 126 into 10,000 kg. So it is 5 lakh 10,000 rupees. We'll tell what is this 5 lakh 10,000 rupees. What is it? It can we can look at it from two perspectives. If internal transfer happens, 5 lakh 10,000 rupees is our benefit. But if internal transfer did not happen, 5 lakh 10,000 rupees is a loss will be. This 5 lakh 10,000 is the potential profit if transfer takes place, and this 5 lakh 10,000 is the potential loss transfer did not take place. This is what this question is trying to tell. Look at the answer. Okay, first situation one. Situation one, we are telling yes, minimum is 210. Okay, maximum is 189. Okay, so no, there will be no mutually agreeable transfer price. Second case, minimum is 126, maximum is 189, so transfer should take place. Third case, Okay, yes, 177, okay, is a bona fide outside price. Even though 177 is less than pulp division's 180 full cost, it is within the range and therefore will provide some contribution to pulp division to recover the fixed cost. I told pulp division will be having that, yes, moral dilemma, telling that my full cost is 180 but I'm getting 177 only. You need to tell that you are recovering fixed cost now. Otherwise, you will not be in a position to recover your fixed cost as well. Keep in mind that. Yes. If pulp division does not meet, if the transfer did not take place, it will lose 5,10,000. Okay. But if transfer takes place, 5,10,000 will be the extra profit. Okay. So how will we get that? It is 177 minus 126.51 per kg into 10,000 kg. This is what it is. Is it clear, students? Yes, this was question number 3. Should we move to the next question, students? Yes, we have question number 4, page 8.35. APL Limited has two divisions, Division X, Division Y. Okay. Division X produces a component JEX, which is supplied to both Division Y and external customers. Division Y produces a product called Jextin by incorporating the component JEX. For 1 unit of Jextin, 2 units of JEX is required. So what is the question telling? We are APC company. Yes, we have two divisions. We have Division X, which is the transfer, Division Y, which is the transfer. Division X transferer, he is producing a component called JEX. Okay, this JEX, he is selling it outside also. He is making the internal transfer also. How much transfer we are making? For every 1 unit of Jextin, 2 unit of JEX is required. We have to produce 1 unit of finished goods, 2 unit of raw material is required. Okay. Now, let's continue it here. Till date, Division Y has always purchased from X. Okay, till today, we have always purchased from X at 50 rupees per unit, since it was the lowest price. Okay, since the lowest price at which it could have purchased was 52. At outside, it was available at 52. So here he was giving at 50 rupees. So we are buying it internally only. Division X charges the same price for component JEX to both Division Y and external customers. However, it does not incur selling and distribution cost when transferring internally. What company is telling? See, JEX, Division X, I'm charging 50 rupees to my external customer also, to my internal customer also. But when I'm incurring the cost, selling and distribution cost, whatever I have, from my external customer I will incur, but for my internal customer I will not incur. This is one point. Now what happened? Division Y has received a proposal at 47 rupees for at least next 3 years. Yes, Division Y, a new supplier has come, he's telling I will give it to you at 47. Saying at least for next 3 years I'll give it at 47. Now Division Y is still thinking, yes, if I buy from X it is 50 rupees. If I buy from outside it is 47. 47 is better, right? But before taking a decision, he goes to X. Okay, he goes to X and he's asking, can you give it to me at 47 rupees? Yes, X is not ready. He's telling my divisional performance is based on profit margin. My divisional performance will be based on my profit percentage. So because my profit percentage will reduce, I will not transfer at 47. 50 if you want, you buy or else go. Yes. Additional information is given to you. Okay, selling price, variable cost, all this is there. Selling and distribution cost is also there of both the divisions. Okay. Annual fixed cost is there. External demand is given. Capacity of the plant is given. Okay. What is required? Calculate the present profit of each division and company. At present, when the internal transfer is happening, what is the profit of division X, division Y company? Next, analyze the impact, okay, on each divisions if division Y accepts the offer from new supplier. If division Y decides we will buy from outside, then what will be the impact on the profit? We need to analyze, not just calculate, analyze and tell. These are the two parts. Third part, we will look at it later on. Okay, first look at this. External demand 1,20,000. So how many units of Jextin will be producing? 1,20,000 units of Jextin we need to produce. And we have told that for 1 unit of Jextin, 2 Jex is required. So for 1,20,000 Jextin, how much Jex is required? 2,40,000 Jex is required. At present, we are transferring internally at 50 rupees, but there is a proposal that outside supplier will give it to us at 47. What do we need to calculate? At present, yes, first part, at present, now when the internal transfer is happening, what is the profit of the division of the company? Now, look at it, division X. What is the capacity of division X? How much units division X can produce and sell? Maximum 5 lakh units. In that internal transfer, 2,40,000 units it is doing. Yes or no? 2,40,000 units it is transferring to Y. Here it is given. So how much maximum it will be in a position to sell? 2,60,000 units only it will be in a position to sell. Yes or no? So even though division X, I have an external demand of 3 lakh, I will be in a position to sell 2,60,000 units only. Is it clear? So how division X is making sale? 2,40,000 will be the internal transfer, 2,60,000 will be the external sale. Now we are calculating the profit. Yes, we'll calculate the profit for division X. For division Y, we add it. Yes, calculate what is the total profit of division X, total profit of division Y, and the profit, we arrive at the profit for the company. First for division X. Division X, what all it is doing? Yes, division X is making an internal transfer of 2,40,000 units. It is making an external sale of 2,60,000 units. For all of those separately, we need to calculate. So firstly, we'll calculate what is the contribution per unit. Internal transfer. I'm telling internal transfer if I'm making. My selling price is 50 rupees. What all variable cost I'm incurring? Look at this. Yes, component JEX. I'll be incurring other material for my internal transfer. Other material 12 rupees, direct labor 16 rupees, manufacturing overhead 2 rupees. But will I be incurring selling and distribution overhead of 4 rupees? I have selling and distribution cost of 4 rupees, but for internal transfer, I'll not be incurring. For internal transfer, selling and distribution overheads will not be there. So what is my variable cost, students? 12 rupees, 16 rupees, 2 rupees. 30 rupees is my variable cost. Yes or no? So how much contribution I will earn? 20 rupees contribution I will be earning. Total variable cost is 30. 20 rupees contribution I will be earning. Okay, like this, how many units I am selling internal transfer? I am internally transferring 2,40,000 units. Externally I am selling 2,60,000 units. So 20 rupees per unit into 2,40,000 units, I'll be earning 48 lakh rupees. This is by internal transfer. Now for external sale, again selling price is 50 rupees only. What all variable cost I have? Other variable cost 30 rupees anyways I have. In addition to that, selling and distribution overheads 4 rupees I have. My total variable cost is 34. So how much is my contribution, students? 16 rupees is the contribution per unit. Like this, I'll be selling 2,60,000 units. So I'll be earning 41,60,000 rupees. Yes or no? Yes. So total how much contribution I'll earn? From internal transfer, I'll earn 48 lakh. From external sale, I'll earn 41.6 lakh. Totally, I'll be earning 89 lakh 60,000. This is my total contribution. From that, I have my fixed cost of division X. 40 lakh is my fixed cost. So how much profit I'll be earning? 49 lakh 60,000 rupees is the profit division X. Clear? So look at how much I am earning for internal transfer, external transfer, get the total contribution minus fixed cost profit. Now, division Y. What division Y is doing? The division X has internal, external, all those drama. Division Y doesn't have any of those drama. What division Y is telling? See, I am buying from division X. Firstly, what is the selling price of division Y? 180 rupees. It is selling Jextin. So the revenue is 180. What all cost I am incurring? Look at this. Firstly, division Y has a selling and distribution cost of 2 rupees. So I'll write the selling and distribution cost of 2 rupees. Now, all other cost, I have my internal transfer price. How much is the internal transfer price, students? What is the internal transfer price? Tell me, students, what is the internal transfer price? Is it 50? Internal transfer price, is it 50 rupees, students? Is it 50 rupees? Tell me. 50 rupees is for 1 unit of JEX. To produce 1 unit of Jextin, how much JEX is required? 2 JEX is required. Yes or no? I am now looking at it from the perspective of division Y. Division Y is telling, see, to produce 1 unit of Jextin, I want 2 JEX. For 1 JEX, I am paying 50 rupees. So for 2 JEX, I am paying 100 rupees. So my internal transfer price is 100 rupees for 1 unit of Jextin. Clear? Yes. What all other variable cost we have? Component JEX 100 rupees anyways considered. Other material I have 22 rupees, labor 13 rupees, overhead 5 rupees. So totally we have 40 rupees. Yes or no? So I'll tell 180 minus 40 minus 2 minus 100. 38 rupees is the contribution per unit into 1,20,000 units. Yes, it is 45 lakh 60,000 rupees minus 20 lakh comes to 25 lakh 60,000 rupees. is the profit of division B. So overall, for the company as a whole, how much is the profit, students? 49 lakh 60,000 plus 25 lakh 60,000. It is 75 lakh 20,000 rupees. The overall profit of the company. Is it clear? Look at this. Yes, institute have done such a big answer. Yes, we have done it so simple. Yes, but still we have got the same answer. Look at this. Division A is 49 lakh 60,000. 49 lakh 60,000, 25 lakh 60,000, altogether 75 lakh 20,000. Same we have got 49 lakh 60,000, 25 lakh 60,000, 75 lakh 20,000. Clear, students? This is the first part of the question. Now, second part of the question we have. What is the second part of the question asking? Analyze the impact if division Y accepts the offer from new customer. If division Y is telling, no, I will buy from the outside supplier only, then what will happen? Look at this, two impacts will happen. First case, we have division X, division Y. Division Y, at present, it was buying from X at 50 rupees. Now it will be buying the component at 47 rupees. So for division Y, it is saving 3 rupees per component. For division X, what is happening? Division X, yes, at present, it was making internal transfer. But if Y is buying from outside, yes, X will tell, okay, I will not make internal transfer. So how much external sales I will be in a position to make? External demand was 3 lakh. Previously also I had a demand of 3 lakh, but 40,000 I had to sacrifice because I'm making internal transfer. Now because I don't have internal transfer, I'll make complete 3 lakh transfer. Clear? Yes. So this is what is happening. X, previously it was making 2,40,000 internal transfer, 2,60,000 external sale. Now internal transfer is not there, so I will make complete 3 lakh external sale. My capacity is still 5 lakh. Now we'll see how much profit we'll earn. Okay, X is making only external sale. Y is also buying from external buyer. So X selling price is 50 rupees. It's all variable cost. Okay, variable manufacturing cost, variable selling and distribution cost is 34 rupees. Yes. So the contribution it is earning is 16 rupees per unit. Like this, how many units it is selling? 16. Like this, 3 lakh units it is selling. So it will be earning 48 lakh rupees total contribution. From that, 40 lakh is the fixed cost. So 8 lakh rupees is the profit. Okay, this is for X. Now for Y. Y is telling my selling price is 180 rupees. Now what are variable cost I have? Look at this. I was telling all my manufacturing and selling variable cost was 42 rupees. Yes, my manufacturing and selling variable cost was 42 rupees, but I had not included the cost of component jacks. Now I am buying jacks from outside at 47 rupees. Yes or no? So for every jack tin, I want 2 jacks. So 47 into 2, 94 will be my component cost. So how much will be my contribution? 180 minus 42 minus 94. I'll be earning 44 per unit into, like this, 1,20,000 units I'm selling. I'll be earning 52 lakh 80,000. 20 lakh is my fixed cost. So I'll be earning 32 lakh 80,000 rupees in profit. Overall, how much is the profit, students? Overall profit is 40 lakh 80,000. This is the revised profit of the company. 8 lakh 32 lakh 80,000. Look at this, 8 lakh 32 lakh 80,000, 40 lakh 80,000. We've done it so simple. They've complicated it. It's such a big drama. Okay, all this is not required. Simply you can do things. Okay, yes, overall this is the profit of the company. Now whether the question is over, no. What is the question asking? Yes, the very important thing is to look at the requirement of the question. Question is telling analyze. We need to analyze the impact on profit. What impact it had on the profit? That is what happened, why it happened, of each division and company as a whole. What happened to each division? What happened to company as a whole? Now we are going to analyze. With this, we are going to analyze and we had division X, division Y, company as a whole. Present, previously what happened? This was the profit. Now this is the profit. Previously X was earning 49 lakh 60,000. Now it is earning only 8 lakh. So now the profit has come down by 41 lakh 60,000. Yes, division Y, previously it was earning 25 lakh 60,000. Now it is earning 32 lakh 80,000. Its profit has gone up by 7 lakh 20,000. Company, previously it was earning 75 lakh 20,000. Now it is earning 40-80 only. So now the profit overall has come down by 34 lakh 40. This is how much it has changed. Now we need to tell why it has changed. Firstly, we'll be talking about division X. Yes, division X. Firstly, we'll be telling, yes, what happened. Yes, in division X, the profit went down by 41,60,000. Previously, it was 49,60,000. Now it is 8 lakh only. Why it has happened? Why it has happened in division X, students? Two things happened. Previously, we were selling 2,40,000 to Y. Now we are not doing that. So that contribution we have lost. Yes or no? We have loss of contribution. How much is the loss of contribution, students, on the internal transfer? Previously, 2,40,000 units we were transferring. On every unit, previously we were earning 20 rupees, if I'm not wrong. Look at this. On internal transfer, we were earning 20 rupees. Now we cannot earn that because internal transfer is not there. So that became our biggest loss. We told 2,40,000 units into 20 rupees, 48 lakh rupees. Yes. Okay, it left us. We are crying, we are in tears. But in that place, what happened? Previously, we were selling only 2,60,000 units outside. Now we are in a position to sell 3 lakh units outside. So extra 40,000 units we are in a position to sell outside. So 40,000 extra units I'm selling. And on external sale, how much contribution I'm getting, students? I'm getting a contribution of 16 rupees. So I'll tell is 40,000 units into 16 rupees per unit. Yes, 6,40,000 gain also I got. So how much is my net loss? 48 lakh loss minus 6,40,000 gain. 41,60,000 is the net loss for me. 41,60,000. Got it? Yes, we need to tell what happened. Yes, profit came down by 41 lakhs. Why it has happened? Previously, I was selling 2,40,000 internal transfer. I was earning 20 rupees. That I lost. Yes, but now extra 40,000 external sale I'm doing. 16 rupees I'm earning. This gain I got. This net is the impact. Now for division Y, what happened? Yes, the profit went up by 7,20,000. Why? What used to happen? Previously, I used to buy the component. Yes, I used to buy the component at the rate 50 rupees. That is, for every finished goods, I wanted two components, I was paying 100 rupees. But now I'm getting it at 47 only. That is, for two components, I'm incurring 47 into 2, 94 rupees only. That is, I'm saving 6 rupee for 1 unit of finished goods. Like this, I have 1,20,000 finished goods. Yes or no? 1,20,000 finished goods I'm selling. 6 into 1,20,000. 7,20,000 is the extra profit, extra saving that I am doing. This is from the perspective of division. Now, we are telling from the perspective of company as a whole. This company as a whole analysis is again important. Look at the students, what we are telling. Company as a whole, what happened? We are telling company as a whole, our profit went down by 34 lakh 40. We are asking why, what happened? We are telling, look at this. Previously, two impacts are there. Yes. Previously, JEX. Okay. Yes, in a year we wanted 2,40,000 JEX. Yes, previously when we were doing, we were manufacturing on our own. Company, now we are looking at it from the perspective of company. Company still. Previously, when we were manufacturing JEX, how much cost we were incurring for 1 unit of JEX? We were incurring only 30 rupees. Look at this. If you are doing internal, our variable cost was only 30 rupees. We were paying 30 rupees only for 1 unit of JEX. But now what is happening? We are buying from outside. So how much we are paying to external supplier? I am paying 47 rupees. How much extra I am paying? I am paying 17 rupees per unit extra. Like this 2,40,000 units I am buying in a year. So 17 into 2,40,000. I am incurring 40,80,000 extra I am incurring. That is one loss I am having. But because of this one small gain I have. What is it? Previously to external customer I was selling only 2,60,000 units. But now I'm selling 40,000 units extra to my external customer. And from every external sale, I'm getting 16 rupees contribution. So 40,000 into 16, 6,40,000 gain also I have. So net how much is my loss? 40,80,000 minus 6,40,000. 34,40,000 is the net loss we have. Yes, this is what we are telling. What happened? Why it happened? What happened? Why it happened? For every division and company as a whole. Yes, this simply we have explained. Look at this analysis. Okay, overall profitability reduced from 75 lakh 20,000 to 48 lakh 20,000. That is, it reduced by 34 lakh 40,000. What happened? Why it happened? Yes, manufacturing cost was 30 only. but now it is purchasing at 47. So 2,47,000 into this. This is one impact. Previously, now it can make external sales extra 40,000 units. On every unit, it is earning 16 rupees. This is the extra contribution. So 34 lakh 40. Next, we are telling division X. Yes, division X from 49 lakh 60,000, it has reduced to 8 lakh. So 41 lakh 60,000, it reduced. What happened? Previously, it was earning 20 rupees on internal transfer. Now it is not earning. So this much is a loss. But 40,000 extra sale we are doing. Yes. So 6 lakh 40,000 is a gain. So net, this is the impact. Okay. And division Y, what is happening? Yes, previously, now we are increasing, our profit will increase by 7 lakh 20,000. Why? Because previously we were buying at 50 rupees. Now we are buying at 47. Total 2 lakh 40,000 units. This will be the, this is what it has told. Such a big explanation. Simply we have explained. This way you need to do. Yes, every analysis, you need not keep looking at what is given. You need to tell, yes, what is the crux? What we have explained in analysis. We have told what happened, why it happened. For division, what happened? Profit increase or decrease. Why it happened? Yes, what happened? Yes, that is what we need to explain. Rest everything we can go on writing in the point of points. Okay, no? Next, the third thing. Okay, yes, the same thing. Okay, overall, what is the loss for the company? 34 lakh 40,000 is a loss for the company. This we got by doing such a big thing. Na? Simply we can get it by using transfer pricing range. Look at this overall impact. I can also get it by transfer pricing range. It is not given in the question, but for you to cross check your answer if it is correct or not. What is the minimum transfer price? Okay, minimum transfer price in this case. What is the minimum transfer price, students? How much variable cost I am incurring for component checks? Variable cost I am incurring 30 rupees per unit. I am transferring 2,40,000 units. Okay, so 30 rupees per unit into 2,40,000 units. Tell 30 into 2,40,000 units, 72 lakh. Specific fixed cost is not there. Opportunity cost. External sale I had 3 lakh, but I'm making only 2,60,000. 40,000 units external sale I'm sacrificing. On external sale, I could have earned 16 rupees. So that I'm sacrificing. 6,40,000. 6,40,000. Total, how much is it? 72 lakh plus 6,40,000 is 78,40,000. This is the total amount we want for 2,40,000 units. So how much is it per unit? 78,40,000 divided by 2,40,000 units is 32.66. We want 32.6666. It is the minimum that we want. How much maximum customer is willing to pay? External buying price 47. So what is the range? 32.6666 to 47. This is per unit. Like this, we have 2,40,000 units. So do 47 minus 32.6666. Do till the very end into 2,40,000 units. You will be getting 34,40,000 rupees. That is what is the overall fall in the profit. Yes or no? Because transfer did not happen. Okay. Yes, same thing. Simply yes, we can do it this way also. Just in 1 minute, we'll get the answer. Now, what is the third part of the question? Third part. Yes. Yes, in the change the scenario. Okay. Yes, we are telling in the change the scenario, revise the scenario. When division Y is telling no, I will buy from outside at 47. Yes, why top management should intervene and advise a suitable transfer price? Yes, to resolve the transfer pricing conflict which promotes goal congruence. Yes, why top management should intervene? Because if top management did not intervene, what will happen? Yes, division B will buy from outside and it will make a loss of 34,40,000 to the company. Yes or no? Division B was getting 3 rupees discount. Because of that, if it takes that decision for company as a whole, 34,40,000 will be the loss. So company has to come, intervene, negotiate. Yes, let them discuss and arrive at a transfer pricing range. You need to tell that no, yes, you cannot buy it from outside. Internal transfer should happen. Firstly, we'll tell if top management did not intervene, what will happen? He will buy from outside and company as a whole will incur a loss of 34,40,000. Then we'll explain the transfer pricing range. Telling the transfer pricing range is 32.66 to 47. So ideally transfer should happen. But if transfer did not happen, this will be the impact. 34,40,000 will be the impact. Next, for X was telling from a long time, I cannot give you a discount. Yes, because my ROI will be affected. Yes, company will tell. Yes, boss, wait. Okay. Yes, you are mistaken. Why? See, on external sale, how much contribution you are earning? Look at this. Okay, external sale, you are earning 16 rupees contribution. So on internal sale, now you are earning 20 rupees contribution. Internal sale, you are earning more contribution. Why don't you give a 4 rupees discount? Yes, on external sale, you are incurring this selling and distribution overheads of 4 rupees. This you are not incurring in internal transfer, right? So why don't you give a 4 rupees discount and transfer it at 46 rupees? Your ROI will not be impacted. That thing we need to tell it to X, yes or no? So that thing also we are telling that, see, on internal transfer, we are saving 4 rupees on selling and distribution expense. Give it as a discount. Your profit ratio will remain as it is. And transfer will also happen because it is in between 32.66 and 47. Okay. Yes, this is one more recommendation. This is a special recommendation which we are giving. And next we will be telling is why X was not willing to transfer. Because he was telling my performance measurement was happening based on my return on investment, how much return, but how much profit percentage I'm giving. Based on that, my performance measurement was happening. We'll be telling always performance measurement should never be based on merely financial factors. Non-financial factors should also be included. We are commenting on the performance measurement, telling that it should never be just financial factors. Non-financial factors should also be included while we are evaluating the performance. This is what is told. Look at the answer. Okay, this company will suffer a loss of 34,40,000. Yes, we've told the minimum and maximum transfer price, transfer pricing range, and all of that it is told. Why it has happened, the entire same last paragraph it is told. Okay, now we are telling what we can do is it given 4 rupees we are saving. Yes. Okay. Other way of looking at it is division X is not incurring selling and distribution cost on internal transfer. So it can reduce its price by 4 rupees while still it can be earning the same profit margin. Okay, that is one thing. Yes, overall next it's the same thing. Transfer pricing range, how we have arrived, how we got the minimum, how we got the maximum, complete story is told. Yes, again, we need to tell that performance measurement should not just be proper financial performance alone. Non-financial measures should be included as well. Such a big thing. See, always whatever is big, break it down into small points, break it into sizable chunks and revise it. One day before examination, if you look at this, there is no way you can forget this in the examination. There is no way you won't write these points. Is it clear, students? Should we continue? Yes, the next question that we have is question number 5, page 8.36. So question number 5 we have. Okay. A company has two divisions, division A, division B. Division B produces the components which are used by division A as well as external customer. Division B is transferring to division A, division B is selling outside also. Okay. Division A is getting its entire requirement from division B. Division A is buying entire raw material from division B only. It is not buying from outside. Yes. What is the production capacity? 1 lakh. Division at present is operating at full capacity with no inventory. Yes, it is selling its components to external customer at 4,000 rupees. Now, division B, if it is selling outside, it is selling at 4,000 rupees. Variable cost is 2,750. Internally, what is it transferring it? It is transferring, factoring any opportunity cost in the form of lost sales. What is it telling? Yes. Otherwise, we'll sell it at variable cost. But if we have any opportunity cost, that also will factor, that also will include in the price. Yes, what happened? What is the sales at division B? 36 crore is the total sale. That external customer we have sold 20 crores. Okay, as per company policy, division A has priority over external customer. Because of this, additional demand of 18,000 components was not catered to. Okay, what we are supposed to do? We need to analyze the sales in terms of rupees and units. Yes, a very interesting question. Look at what is happening. Yes, we have two divisions. Division B is the transferor. Division A is the transfer. Okay, yes, transfer is happening at marginal cost. Yes, if there is no opportunity cost, we will transfer at the variable cost. If opportunity cost is there, we will include the opportunity cost and transfer. Now, division B is selling to external customers also. Okay, we are selling it to external customers also. What is the price at which we sell to external customers? 4,000 rupees. How much is the variable cost? 2,750. On every transfer, I am earning, yes, 1,250 contribution. What is my total capacity? 1 lakh units is my total capacity. And actual sales is given. Yes, it is told that totally I have sold 36 lakh, I have made a 36 lakh rupee sale. out of which external sale is 20 crore rupees. Sorry, 36 crore. Totally, I've made a sale of 36 crore, out of which my external sale is 20 crore. Again, one more information which is given is 18,000 units. External sales I've sacrificed. I could not cater. Why I could not cater? Because I'm giving priority to internal transfer. Now, what I need to do? This 36 crore sale, how much is external, how much is internal in terms of units, in terms of value? That I need to analyze. How we do is very interesting. Look at this. We'll tell total crore how much, total sale how much it is, 36 crore. Out of that, external sales, how much is it, students? 20 crore is external sales, which is given. Okay, 20 crore is the external sales that is given here. So how much will be the internal sales, students? So the internal sales will be 16 crore. Now how much units we are selling, we don't know. But total our capacity is 1 lakh. So totally we'll be selling 1 lakh. Now external sales, we are making external sales at a selling price of 4,000. All external sales we are making it 4,000 rupees per unit. So how many units we would have sold? Is 20 crore divided by 4,000 rupees per unit. We get the number of units. How many units we are selling, students? 20 crore divided by 4,000 units. Yes, we are selling 50,000 units outside. 50,000 units we are selling outside. That means that balance 50,000 units we are selling inside. So total my capacity is 1 lakh, out of which 50,000 I am selling outside, 50,000 I am selling inside. Okay, yes, external sale I am transferring it at, selling at 4,000 rupees. Now internal transfer, what is the transfer based on? Transfer is based on my marginal cost. I am telling, if there is no sacrifice, I will transfer it at my variable cost. If I am sacrificing, I will be transferring it at my, yes, including my opportunity. Now, in this 50,000 units, question is given us a line. It is telling that for 18,000 units, the external sale was sacrificed. What happened? I had an external demand of 68,000 units. But because I am making my internal transfer for 18,000 units, I could not make my external sale. I am telling, for 18,000 units, I am sacrificing my external sales. So I want to include my contribution as well. So transfer price, I'll tell, I want my variable cost of 2,750. I want my opportunity cost, my contribution of 1,250. I'll be transferring it at 4,000 rupees. Okay. But for the balance units, out of 50,000 units, for 18,000 there was external demand. But for balance 32,000 units, there was no external demand, right? So I'll tell, okay, whatever is my variable cost, at that I'll transfer it at 2. This is how we are going to analyze the demand, analyze the sales. So we are going to prepare a summary of the sales. We'll tell external, we've sold 50,000 units at the rate 4,000. So it comes to 20 crores. Now internal transfer without opportunity cost, 32,000 units have transferred, for which there was no opportunity cost. 18,000 units have transferred, for which there was opportunity cost. If opportunity cost was there, I have transferred it at 4,000 by factoring the opportunity cost. Opportunity cost was not there, I transferred it at my variable cost 2,750. 32,000 into 2,750 is 8 crore 80 lakh, 8.8 crore. 18,000 into 4,000 is 7.2 crore. So altogether it will be 16 crore. This is how I am getting an external sale of 36. Okay, this is what we have done. Okay, here we have done in the form of a chart, in the form of a table. Yes, again, if you look at institute's answer, yes, institute doesn't use table. It doesn't like table. It doesn't like chart. Everything they'll write it in paragraph. Yes, even the practical paper also, they make it look as though it is a theory paper. Yes, what they've done? Nothing. They've told total sale is 36 crore, out of which external sale is 20 crore. That means that the internal sale is 16 crore. They have written in the form of a paragraph. Yes, the external sale of 20 crore. Yes, the selling price is 4,000 rupees per unit. So the number of units sold would be 50,000 units. Second paragraph there. Yes. If external sale is 50,000 units, that means that internal sale would also be 50,000 units. Again, one more paragraph. That's what they've done. Okay. Yes, so if you look at the answer also, same complete paragraph is written, sales analysis. Same thing they're writing, 1 lakh units. Okay. Yes, 4,000. So 50,000 units. So balance 50,000 units. Okay, out of this 2,750 is for 32,000 units. For 18,000 units, it will be at 4,000 rupees. Okay, contribution has to be earned. So based on that, yes, ultimately they've written final summary also they didn't do in the form of paragraph. They're again telling 32,000 units at 2,750, 8.8 crore, 18,000 units at 4,000, 7.2 crore. Yes, this is the internal sale. External sale is 40 crore. This is how we got. Okay, this is the first part. Yes, always do we need to write it that way? Is it possible to write it that way? Always write it in the form of tables, in the form of points, simple things. Okay, do not write it in the form of paragraph. Even examiner cannot read that. Okay, our answer should have basic ICS presentation. Is above than that, we can always make it better. Okay, so always aim to make it better. Next, recommend a transfer pricing range that would promote goal congruence between the two divisions. What transfer pricing range we are telling? We have two different units. For 18,000 units for which we are not making any sacrifice. Yes, division A is telling minimum I want 2,750. Division B is telling if I buy it from outside 4,000, so maximum I'm willing to pay 4,000. For the balance 32,000 units, yes, division A is telling yes, I'm sacrificing, so I want 4,000. Division A is telling okay, I'm willing to pay 4,000. So there is no range. Yes, the transfer will happen at 4,000 rupees. This is the transfer pricing range. Third, what we are telling. Look at this. Third thing is also good. Discuss the effect of changes in external demand on transfer price, assuming that the current policy. What is the current policy? Yes, if there is extra demand, yes, we are going to give priority to our internal transfer. So if we are going to give priority to internal transfer, how will the transfer pricing be there? Look at this. What is the company's policy that we are going to give priority to division A or external sale? We need to tell what happens if there is a change in external demand. Change in external demand means demand could be more, demand could be less. Yes, if anything happens, what is going to happen? Just we need to give an overall picture. See, we are telling what all cases could be there. Okay. Division B. Now at present it is transferring internally, it is selling externally. So there could be two cases. First is external demand is not there at all. Second case is external demand is there. Okay, so if external demand is not there at all, there is no external demand only. Yes, division B will tell whatever is my variable cost and that I'll transfer. My transfer price will be 2,750. But if external demand is there, I will see how much is my external demand. Whether my external demand is very less, that is whether the total sale is within my capacity, that is internal plus external is within 1 lakh. Yes. Is it that case? Or else is it going beyond my capacity? Yes. Do I need to sacrifice something? There could be two cases. If the total sale is within the capacity, still I'll tell, okay, external demand somewhere around 50,000 units is there. Internal also I'll transfer 10,000 units. So I'll transfer it at 2,750 only, no issues. But if it is going outside my capacity, I will have to start charging my opportunity cost. So the transfer pricing range could be somewhere between 2,750 to 4,000. Yes or no? It will be somewhere in that range. The transfer price will be somewhere in the range 2,750 to 4,000. Now, will it be close to 2,750? Will it be close to 4,000? How will we get? It depends on how much percentage external sale I am sacrificing. Suppose I am telling total 1 lakh. Okay. Yes. Suppose my external demand was 51,000. Okay. So I am sacrificing 1,000 units of external sale. Oh, very little external sale I have sacrificed. So my minimum transfer price will be closer to 2,750. So if lesser percentage of sale is sacrificed, transfer price will be closer to 2,007. But a higher percentage of sale is sacrificed. I had an external sale of 1 lakh. I sacrificed 50,000 units. So it will be closer to the higher end. My transfer pricing will be closer to the higher end, 4,000. So if a higher percentage of sale is lost, transfer price will be closer to the higher. This is what is given in the form of a paragraph. Look at this. Look at the impact. Okay, first. Yes, we are telling what is the company policy. Division B is getting priority. If there is no external market, yes, transfer will happen at 2,750. If external market is there, yes, it depends on whether we have to incur opportunity cost or not. If the total demand is within the production capacity, yes, internal plus external is within 1 lakh, entire demand can be met. So again, it will be 2,750. But if there is external market such that, yes, it goes beyond the production capacity, yes, that means I need to charge my opportunity cost. Okay, so it will be between 2,750 to 4,000. So where will it be? Will it be closer to 2,750? Will it be closer to 4,000? It depends on how much percentage we are sacrificing. Yes, more lost sales, more sales I'm sacrificing will keep the average transfer price closer to 4,000. Lesser lost sale will keep it closer to 2,750. So the proportion of external demand which could not be catered into would determine the average transfer price. Higher demand from external customers would drive up the average transfer price within the company. Yes, complete. So simply we can explain, but yes, they have complicated, written a complete one-page paragraph, and we want to read that paragraph. Simple it is. Yes, it's what all cases are possible, and in all the case, what will be the transfer price? No external demand, 2,750. External demand is there, but no sacrifice I'm making. Still 2,750. Sacrifice I'm making. How much sacrifice I'm making? Very little sacrifice, it will be closer to 2,750. Too much sacrifice, it will be closer to 4,000. That is all we have. Is it clear, students? Yes, should we move to the next question? Next, we have question number 6. Yes, let's have a look at question number 6. Okay, yes, more or less same to the previous question, I guess. No, it's not same to the previous question. Question 6 and 7 are almost similar. Okay. GL Limited is a multi-product manufacturing company having 4 divisions. Yes, firstly, we have electrical division, yes, which is manufacturing the switches. Okay, division is functioning at its maximum capacity. It is selling it in the outside market 25 rupees. Variable cost is 60. We have one more division, which is the household division. Yes, it is functioning at 70% capacity. It is asking electrical division, is please supply me 5,000 switches per month at 18 rupees. Yes, whether electrical division will supply, yes or no? I am operating at my full capacity. I am selling outside at 25 rupees. I don't have spare capacity. He is asking, give it to me at 18 rupees. It will get lost. I won't give you. Yes or no? Yes. He is telling, yes, I am manufacturing night lamp. In my night lamp, my total cost will come to 129 rupees. In that, I have assumed that you will give it to me at 18 rupees. Then it will come to 129, and I will be in a position to sell it at 130 rupees. Well, your profit, your concern. Yes or no? Why are you bringing me in this? Yes. Yes. Now, yes, household division is working with a very small market. All these things it is telling. Yes. So it cannot pay more than 18 rupees is what it is telling. Again, manager is telling that, it is very much essential to keep the market share because we want to retain the experienced workers. Telling, yes, we have some experienced workers. We don't want to let them go because in the future we won't get them back again. So we need to keep producing the goods. We cannot tell that because it is unprofitable, we can get out of the business. Again, company is using return on investments as a scale to measure the divisional performance. Yes, we are measuring performance based on ROI, and it is using marginal costing for decision making. Required. Would you recommend the supply of switches to the household division by electrical division at 18 rupees? It is asking, if you were electrical division, if you were transferer, will you transfer it at 18 rupees? Yes, we will never transfer. Yes or no? Substantiate with suitable reason. What is happening? Yes, we have GL Limited. Yes, 2 divisions. One is electrical division, transfer, household division. Yes, what electrical household division is telling? Yes, please transfer 5,000 switch at 18 rupees. I am operating at 100%. My selling price is 25 rupees. My variable cost is 16 rupees. Okay. Yes, whether I will transfer at 18 rupees? Never. I will never transfer at 18 rupees. I am telling I am operating at 100% capacity. So minimum I want is my variable cost and opportunity cost. Give me my variable cost of 16, opportunity cost of 9. Give me 25 rupees, take the goods, take the lamp. Otherwise, get lost. Yes or no? So, what we are quoting? Yes. Customer is quoting 18 rupees. I am telling minimum is 25 rupees. So, I will not accept the internal transfer. I will call him and I'll nicely tell him, see boss, I want to accept. You're like my friend only. I would have helped you. But the issue is my performance evaluation is based on my return on investment. I transfer it to you, my return on investment will go down. So I cannot do it. Kindly, sorry, tata, bye bye. So if I accept, my ROI will be affected. So I will not I will not transfer, is what electrical division is telling. Okay. Okay, yes, so selling price is to 25. If it is 18, no. Yes, it is based on ROI, so it will not transfer, it will not accept, is what the first point is telling. Second point, analyze whether it would be beneficial to company as a whole to supply the switches at a unit price of 18 rupees. We are telling whether from the perspective of company, transfer should happen. From the perspective of company, transfer should happen at 18 rupees. See, from the perspective of company, transfer happens at 18 rupees, 20 rupees, 21 rupees. For company doesn't make a difference, because ultimately in one division revenue, one division cost, it gets balanced. The question is whether from the perspective of company, transfer should happen or not. We are telling yes, we look at the transfer pricing range, and if transfer pricing range exists, we are telling yes, company wants the transfer to happen. So let us calculate the transfer pricing range. Minimum transfer price, because we are operating at 100%, the minimum we want is a 25 rupees. Maximum transfer price, yes, it is external buy-in price or net marginal revenue, whichever is lower. External buy-in price is not given, so we don't have external buy-in price. But net marginal revenue, what is the net marginal revenue, students? Yes, the question has given us a paragraph telling what all we do, how much will be the selling price. All of that is given. Household division is marketing the night lamps at 130 rupees. So he is selling, yes, we will sell. If we sell, we will get 130 rupees. We'll tell, okay, you sell and you get 130 rupees. What all variable cost we need to incur? He's telling the total cost is 129. We tell, don't tell total cost. Yes, forget your fixed cost. Fixed cost is irrelevant. So 21 rupees fixed cost is irrelevant. Then again, he's telling us, yes, this switch we've assumed at 18 rupees. You're telling how much price we need to pay. We will tell, don't assume 18 rupees. What is the other variable cost? Tell me other variable cost. Okay, he's telling what other components I want. 50 rupees other component I want. Other variable cost 40 rupees I want. 90 rupees is my variable cost. So you're telling, 40 rupees you have in my hand, and then you're telling I don't have profit and all of that. Yes or no? So he's getting 130 rupees. How much he is paying? For other component he is paying 50 rupees, and for other variable cost he is paying 40 rupees. Yes, 90 rupees he is paying. Still he has 40 rupees. Still he is begging and telling, yes, we are poor, we have only 18 rupees, we have fixed cost, we are incurring loss, we want to retain experienced employees and all. Yes or no? It's maximum how much he is in a position to pay. He is in a position to pay is 40 rupees. So the transfer pricing range, whether it exists, yes, transfer pricing range exists 25 to 40. So what company wants? Ideally, company wants that transfer should happen. If transfer happens, how much is the benefit company will earn? 15 rupees per unit it will earn. Like this, how many switches we have to transfer in a month? 5,000 switches we have to transfer in a month. 15 into 5,000. 75,000 rupees will be the benefit if transfer happens. Ideally, company is telling that transfer should happen. What is the conclusion we are telling? Is internal transfer should happen. It is profitable to the company, and if it happens, yes, we can save 75,000. We will earn 75,000 rupees in profit. That is one impact. Again, we can retain the experienced employees as well. That is the second impact. Yes or no? That is what is given here. Look at this. Second place. Okay, total cost is fixed overhead is not relevant. Okay, it's only relevant cost is C. Therefore, it is beneficial to company as a whole to the extent of 15 rupees per lamp sold. Yes. So internal transfer is profitable to company as a whole. Yes. Further, because household division is operating at 70% capacity and has experienced worker which may be utilized for other division, yes, and any contribution based could be minimized due to large scale production. You're telling, yes, we have experienced workers also, we can retain those experienced workers, and because we are operating at 70%, if they have free time, we can use them for other work as well. This is what, yes, the second part of the question. What is the third part of the question asking? Third part of the question is asking us, do you feel that divisional managers should accept the internal divisional transfers in principle? If so, what is the range of transfer price? Every time question asks, yes, whether divisional managers, yes, should accept the transfer in principle, we need to tell what is the divisional transfer price. Okay, so again we are telling the divisional transfer price, the transfer pricing range we've already calculated is 25 rupees to 40 rupees. Okay, and again some theory we need to tell. Yes, what we need to tell? We are telling, see, when internal transfer happens, what all disadvantage we have? Okay, yes, divisions, every division is working for their own interest. They are not thinking about the company. Yes, what this will happen? It will go to a situation which leads to suboptimal utilization of resources. Yes or no? In this case, we saw ideally for the company transfer should happen, but they are not willing. He is telling I will give 18 rupees only, so transfer is not happening. So yes, because of internal transfer, we have two disadvantages. Divisions are only looking at their performance, so it will lead to suboptimal utilization of resources. So to overcome this, what company should do? Company should establish a transfer pricing policy. Company should tell in this range transfer should happen. Should means should. There is no ifs and buts. Yes, company should establish a transfer pricing policy to promote goal congruence. And if transfer pricing is within the range, then the managers should accept the divisional transfer price in principle. Yes, if the transfer price is within the range, okay, if they are telling the range is 16 to 30 rupees, then wherever within the range transfer is happening, both the managers should accept it in principle, because they are knowing that it is overall beneficial for the company. Yes, this is what is told in the third part of the question. Internal transfer pricing develops competitive settings for manager of each division. It is possible that they may operate at the best interest of individual performance. What is the disadvantage? Again, it will lead to suboptimal utilization of resources. So what company should do? Company should create a transfer pricing policy. Yes, and okay, divisional manager should accept the internal division transfers in principle when the transfer price is in the given range. Okay. This is the third thing. And the fourth thing we have is suggest the steps to be taken by CEO of the company to change the attitude of divisional heads if they are against the internal transfer. If they are against the internal transfer, what steps can we take to avoid transfer pricing conflict? Okay, concept 3, we have the miscellaneous areas. In that, we have one thing, proposals to resolve transfer pricing conflict. How do we resolve transfer pricing conflict? Yes or no? What is the conflict that is happening? Yes, transferor wants transfer pricing to be maximum. Transferee, customer wants transfer price to be minimum. Yes, there is this conflict, there is this fight, never ending fight. How do we resolve? There are two methods, very important from theory perspective. Every time they ask, how do we resolve the transfer pricing conflict? What CEO should do to resolve this conflict? Yes, dual rate transfer pricing system, that is one thing. And next is two-part transfer pricing system. Very important from theory. All these things we need to write in the theory question if it is asked. What is happening in dual rate transfer pricing system? We told company, we have transferor, we have transferee. What transferor wants? He wants the transfer price to be maximum. Transferor is saying, I want maximum transfer price. So you are telling you want maximum transfer price, right? So we'll give you the maximum transfer price. Yes, what will be your transfer price? Whatever is the full cost you have incurred plus profit will give you. You're happy? Yes, you have recovered your full cost. You've earned profit also. Are you happy? Yes, he's telling I'm happy. Now transfer is crying, telling you so much cost I have to pay. Yes, from my pocket it will go. So telling you what you want. You want the cost to be minimum, right? So for you, I will tell your transfer price is just the marginal cost. Whatever is the actual cost, and that will shoot in your books. So in both the divisions, we are maintaining separate books. As transferers books, when sale is happening, we are showing it at the market price, full cost plus profit. Assume the variable cost is 60 rupees, market price is 130 rupees. So in transferers books, he is telling, okay, I have sold the goods, I have sold it at 130 rupees. He is happy telling, oh, I have sold it at 130 rupees, I have made so much profit. Transfer is also happy. Yes, in his books, he is showing it at 60 rupees. He is telling, okay, I have paid just 60 rupees. Market it is available at 130 rupees. I have purchased it cheap. Okay, both of them are happy. So what is happening? Supplying division, transferring division will record the transfer price at full cost plus profit. Purchase division will record the transfer price at marginal cost. What will be the benefit? Yes, firstly, it promotes goal congruence. Now, transferor is also willing to transfer. Transfer is also willing to transfer because both of them are happy. Again, because it is promoting goal congruence, it promotes cooperation between the divisions. Yes, both divisions cooperate amongst each other and ensure that, yes, they make the transfer possible. This is the benefit. But what is the drawback here? It is complicating the records. Yes or no? In one place, we are showing we have yes, internal we have artificial profit. Yes, we are complicating records. Here we are showing, okay, we have sold at 130 rupees. Here we are telling, yes, we have purchased at 60 rupees. So, yes, there is a probability, there is a chance of mistakes happening. That is one thing. And second, profit shown is artificial and should be used only for internal evaluation. Whatever is the profit we are showing here is only artificial because actually it is just internal transfer. Here I am telling, yes, I have earned 60 rupees profit. It's an artificial profit. Finally, while you are finalizing the books, this has to be eliminated and this should be kept in mind. Only for internal evaluation, while I am evaluating how much profit this division has earned, only for that we can use. Otherwise, we should not be using this profit. Okay, those are the two disadvantages. So we have dual rate, two different rates. For transferal, it is the full cost plus profit. For transferee, it is the marginal cost. Next, we have two-part transfer pricing system. Again, what is the conflict? Transfer is telling, yes, I should get more profit. Transfer is telling, my cost should be minimum. So what we are telling in two part, transfer price is calculated in two different parts. We are telling transfer price is a marginal cost plus a lump sum charge. Suppose we are transferring this pen. We are asking how much is the marginal cost. This transfer is telling 10 rupees. We'll tell, yes, you transfer it at 10 rupees. Now transfer starts crying. I am not getting profit only. What will I do? And all of that. We'll tell, in a year, yes, 5 lakh extra you charge. Okay, for every unit, 10 rupees you charge. But in a year, 5 lakh will be extra you will be charging. That is towards your fixed cost. Now transferor is happy, telling that, okay, in a year, 5 lakh I am getting. Now transfer is crying. Yes, we'll tell transfer, see, if you are buying it from outside, it will cost you 20 rupees. Like this, if you are buying, say, for example, 1 lakh unit, it will cost you more. But now your cost is also less. If you're buying from market, the market price is more. This is comparatively less. So you're also in advantage. You're telling transferor, you're also in advantage because you're getting a lump sum. Transferee, yes, you are telling transferee, you're also in advantage because you're not paying as much as market price. It is, yes, whatever the marginal cost plus lump sum together, it is lower than the market price. Okay, so transfer price is the marginal cost plus a lump sum charge. What is the benefit? Supplying division is happy because it is in a position to earn the profit. Receiving division is also happy because it can purchase the goods at a lower rate. Yes, this is what it is. So in the fourth part of the question, they have asked what CEO should do, yes, if they are against interdivisional transfer. Yes, we have two methods, dual rate transfer pricing system and a two-part transfer pricing system. Yes, it has to be explained, the complete theory what we have told. See, dual rate, two-part is explained. Is it clear, student? This was the question number 6. We have one final question. Should we finish it off, students? Are you guys ready? Yes, we have test your knowledge question number 7. Great Vision manufactures a wide range of optical products, including lenses and surveillance cameras. We are a company, we are producing many products. Okay, Division A manufactures lenses, while Division B manufactures the camera. We have Division A, which is manufacturing the camera lens. Division B is manufacturing the camera. For the camera, we want the camera lens, which is transferred. Lenses that Division A is manufacturing is of standard quality. Is due to huge demand, it is operating at full capacity. It is selling it at 140 rupees. Variable cost is 110. Total cost is 125. At present, for camera, we are buying lenses from outside. Okay, total production cost of camera is 400. Currently, we are buying lens from outside at 170 rupees. Yes, management is telling, why don't you buy it in-house? Yes, let's use the in-house capabilities so that consequently the procurement cost will reduce. It is proposed that Division B should buy 5,000 lens each month at 120 rupees. Okay, yes, estimate cost of surveillance is given below. Look at this. Division A, transferor, it is operating at full capacity. It is selling at 140 rupees. Now we are telling, yes, you transfer to Division B at 120 rupees. Will it be happy? No, it will not be happy. It will tell, I'll sell it outside, I'll get 140 rupees. Why should I transfer at 120 rupees? Yes, that is one thing. But whether Division B transferee is happy? Yes, he is very much happy. Yes, previously he was purchasing from foreign vendor at 170. He was paying 170. Now he's paying 150, 120 only. He's saving 50 rupees, doing nothing. Yes or no? So all cost structure is given. Okay, each surveillance camera is sold for 410 rupees. Yes, margin is low because the competition is high. If we increase the price, market share will go. Yes, so we cannot pay more than this. We are using ROI, okay, to measure the performance. Analyze what is required. Analyze the behavioral consequence of each division if division A is supplying the lens at 120. Substantiate your answer based on information given in the problem. Look at what is happening. Question number 7 we have Great Vision. Okay, Great Vision is having Division A, which is manufacturing the lenses, Division B, which is manufacturing the camera. At present, Division A, it is operating at full capacity. It is selling at 140 rupees. It is incurring a variable cost of 110. Total cost is 125. At present, camera, it is buying the lens from a foreign vendor at 170 rupees. But what company is telling, in between it is coming and telling, is you transfer 5,000 lens at 120 rupees. Now we need to analyze and tell the behavioral consequences. Behaviorally, what happens? First, Division A. Division A will tell how much loss it is incurring. Present and proposed. Yes. Present, at present, it was selling the camera at 140 rupees. Yes or no? Yes. But in future, yes, if it is making internal transfer, it will be in a position to charge only 120 rupees. At present, it was earning a contribution of 30 rupees minus fixed cost of 15 rupees. It was earning a profit of 15 rupees. Yes, total cost is 125. Return on investment. It is the return divided by investment. How much return we are getting as a percentage of our investment? What is our return, students? It is our profit. What is our investment? How much amount we have invested? Is the how much is the total amount we have invested? Total cost. 15 divided by 125. Yes, it is 12%. At present, we are earning 12%. But in the proposed case, if selling price, transfer price is 120, contribution will be 10. Yes, minus fixed cost of 15, profit will be minus 5. So, it will be minus 4 percentage. So, what division A, transfer division is telling? Yes, it is telling, see, I am operating at full capacity. So, if transfer should happen, at least give me my opportunity cost. At least give me 140 rupees. Yes, then I will transfer. Again, it is telling at present I was earning 12% ROI, but in the proposed case, it will become minus 4%. Again, you guys are telling make the transfer. You guys are only telling yes, we are going to evaluate your performance based on ROI. Then what will I do? Yes or no? So division A will not accept the transfer price. Manager will tell yes, will not accept. We'll sit for strike. Hunger strike. Bhook hartal will do. Okay. Yes. Again, what he is telling, yes, our employees are working so hard. Yes, they are building such great products. Yes, we have a complete external demand in the market. Till you are making an internal transfer and telling our performance is not good, it will demotivate our employees because the performance evaluation is based on ROI. Either you change it from ROI or you increase the transfer price to 140. Do one of those. Otherwise, this is not happening. Yes, we are not happy. This is what division A is telling. Now, again, what company wants to do, see, we are telling from the perspective company also. Company wants to increase the capacity. Company is telling, see boss, now you are in a position to sell only now you are in a position, now you are working at 100% capacity, right? Yes, we want this internal transfer to happen. We will increase the capacity, will infuse more funds, more fixed cost. Okay, because of which you will be in a position to produce more cameras, lenses in-house only. But what, yes, division A is telling, see, if more investment is infused, fixed cost will go up. So I should be at least recovering my fixed cost. Here I am not even in a position to recover my fixed cost. My fixed cost is 15, my contribution is 10 rupees. So company, yes, division A is telling, yes, I am unable to recover my fixed cost at 120 rupees. So please kindly don't extend the capacity. Yes, we will not make the internal transfer. Yes, overall, if division A tells like this, it is detrimental to company as a whole because company wants the transfer to happen. If transfer is happening, it is beneficial for company, but division A doesn't want it to happen because of the low transfer. It is with respect to division A. Look at the analysis. Division A, it has huge demand. Presently, it is earning 12% ROI, but if it sells, overall it shows a 5 rupees loss. Okay, yes, it is because we are only partially recovering our fixed cost. Opportunity cost also we are not recovering. Therefore, it will result in lower divisional profit. So manager will not accept the transfer price. Okay, it will again demotivate the employees. Yes, yes, management of the company wants to increase the capacity or infuse more investment, but due to inability to recover fixed cost, yes, what divisional performance will be impacted. So it will oppose the decision because it will lead to higher fixed cost. At an overall level, it will be detrimental to company, leading to suboptimal. Same thing we've written in the form of points. Firstly, we'll tell what is the present and proposed ROI. Secondly, we'll telling because we are operating at 100%, at least we want to recover our opportunity cost. At least give us 140 rupees. We will not accept transfer pricing. Our employees are not motivated. Our employees are demotivated. From the company, you want to increase the capacity, but we will not give you cooperation because you are not allowing us to recover at least our fixed cost. Okay, so this is detrimental to the company. Now, what division B is thinking? Division B is very happy. Yes, now presently it was buying from outside at 170. Now it is getting at 120 rupees. 50 rupees profit, nothing it is. It is sitting, just it is telling the company, yes, let the internal transfer happen. 50 rupees it is giving. Very much happy it is, yes or no? Present case, look at this. The selling price is 410 rupees. Yes, what all cost we have? Yes, lens cost. At present, we were buying at 170 rupees. Other variable cost, what all we had? 150 and 30, 180 rupees we had. Okay, so overall 350 was the cost, 60 rupees was the contribution, 50 rupees was the fixed cost, 10 rupees was the profit. Overall, how much is the cost, students? Look at this, 170 plus 180, 350 is the fixed variable cost, 50 is the fixed cost, 400 is the total cost. So 10 rupees on 400 rupees comes to 2.5% ROI. Presently, we are earning 2.5%. But in the proposed case, lens will be getting it at 120 rupees. Other variable cost will be 180 only. So 300 will be the variable cost, 110 will be the contribution, 60 will be the profit on a total cost of 120, 180, 300, 350 rupees. So 60 upon 350. Yes, it will come to 17.14%. Or no? So division B is very happy. It is telling yes. Right now it was 2.5%. Now it is 17.14%. Dev Manu Seretu. Yes, you are very good. Yes, this should happen to us. Yes, all employees are happy is what it is telling. Present it was 2.5%. Proposed it is 17.14%. So division B manager will accept the transfer price. Okay. Division B. At present 2.5%. Proposed is 17.14%. Nothing is given in the paragraph. The calculation which you have done in the form of a statement, they have done in the form of a paragraph. So by procuring lens internally, the profit will increase. The manager of division B will accept the transfer price. This is the first part of the question. Now, what do we have in the second part of the question? Analyze if it is beneficial for company as a whole to transfer at 120. We're telling whether for company as a whole transfer should happen. Whether for company as a whole transfer should happen. How do we tell? Yes. Two ways we can tell. Yes, either we can tell based on transfer pricing range we can tell, or else we can tell how much benefit division B is having, how much cost division A is incurring. Based on that we can tell. Now, division B, how much benefit it is earning. See, previously division B was buying at 170 rupees. Now it is getting at 120 rupees. So division B is earning 50 rupees extra. Yes or no? Look at this. 50 rupees extra it is earning. Like this, how many lenses we are transferring, students? 5,000 lenses we are transferring. So 50 rupees per lens into 5,000 lens. Yes, 2.5 lakh is the benefit for division B. What is the cost for division A? Division A is telling, yes, outside I was selling at 140 rupees. Now you are only giving me 120 rupees. I am losing 20 rupees. Yes or no? Outside I was selling at 140. Now I am getting 120. 20 rupees I am losing. See, from 15 minus 5 rupees I am going. 20 rupees I am losing. 20 rupees is for one lens. So like this, I have 5,000 lens. So 1 lakh I am losing. So overall 1.5 lakh is the benefit for company. Overall benefit for the company is 1,50,000. This can also be got through transfer pricing range. Let us do the third part and arrive at the transfer pricing range. Transfer pricing range. Yes, what is the minimum transfer price? We are telling variable cost plus opportunity cost plus specific fixed cost. We want at least 140 rupees. Yes, because we are operating at full capacity. What is the maximum transfer price? Yes, at present, division B is buying from outside at 170 rupees. So either 170 or net marginal revenue. How much extra marginal revenue it is getting? Look at this, students. Selling price is 410 rupees. Yes or no? Selling price of camera is 410, right? Selling price of the camera is, yes, selling price of the camera is 410. We're telling, yes, if you sell, you get 410. Yes, what all variable cost you're paying? Yes, forget the lens, other variable cost. Component 150 we need to pay. Yes, other variable cost 30 we need to pay, 180 we need to pay. So how much will be there in your hand? 410 minus 180. Yes, 230 rupees will be in your hand. So he is telling, see, if I buy from outside, I would have paid 170. Net cash I have with me is 230. Maximum I am willing to pay is 170 rupees. So if you want to calculate the benefit here also, you can get, yes, difference, maximum minus minimum. It is 30 rupees per unit into 5,000 lenses. 30 into 50 will be 1.5 lakh. So 1.5 lakh is it. Transfer pricing range also we have calculated. It is 140 to 170. Okay, let us look at the answer. Third is range of transfer price. Yes, analysis of overall benefit for the company. For division B, okay, division B, it is saving 3 lakh rupees. Okay. So overall net benefit to the company is 1,50,000 rupees. 1,50,000 is a net benefit to the company. Okay, the entire paragraph, same thing is told. It's a range of transfer pricing. Okay, minimum 140. Maximum, we have external buying cost. External buying cost is 170. Net marginal revenue is 230. So maximum will be paying 170 rupees. So acceptable transfer pricing range would be 140 to 170 rupees. Same thing, just they have filled in the pages. Okay, nothing more is there. The same thing. Next, what else do we have, students? Advice on alternative transfer pricing model that CEO can consider to change the attitude of divisional heads. Alternate transfer pricing model. How CEO can avoid transfer pricing conflict. We have two models: dual rate transfer pricing system and two-part transfer pricing system. Write down the theory of that. Finally, calculate the range of transfer price. If division A has excess capacity and can accommodate internal requirement of 5,000 lens within the current operation. We are telling if division A has excess capacity, then we will only consider the variable cost. We don't want profit. Yes or no? We'll tell what is my variable cost for division A. Division A has a variable cost of 110. Yes, maximum transfer price division B is willing to pay. It is lower of 170 or 230. It is 170. So range will be 110 to 170. This is the question. We have the final case. Yes, dual rate two-part transfer pricing. The range of transfer pricing minimum is 110. Maximum will be 170. So it will be 110 to 170. Okay. So this was this question. Okay, so with this we have finished 5 questions today. Balance questions we'll be doing tomorrow, students. So let's quickly have a look at what we have done. We have begun the chapter transfer pricing. So transfer pricing, when goods or services are transferred from one division of an organization to other division of the same organization, and the price at which the goods or services are transferred is called as transfer price. Yes, we've looked at the very basics. Then we've looked at the methods of transfer pricing: cost based, market based, negotiation based. All are not that important from the examination. What is important is the negotiation base, that is arriving at transfer pricing range. We've told transferer will always keep in mind the minimum, how much minimum he should get. He should be getting his marginal cost, that is variable cost, specific fixed cost, opportunity cost. How much maximum transfer he will pay. Transfer he will be thinking how much maximum I can pay. How much maximum he will be paying? External buying cost. If I'm buying from outside, how much is it? Or net marginal revenue, how much net cash I have in me, whichever is lower. Yes, external buying cost, net marginal revenue, whichever is lower. External buying cost is external purchase price plus or minus alteration. Net marginal revenue is final selling price, how much I'm getting, minus other variable cost. Whichever is lower will be our maximum transfer price. And if transfer pricing range exists for company, ideally transfer should happen. Range does not exist, ideally for company, transfer should not happen. What is the benefit or loss if transfer happens or does not happens? Is maximum transfer price minus minimum transfer price into number of units. Okay, yes. Next we have discussed how do we resolve transfer pricing conflict. Important from the perspective of theory. We have told we have two methods. First is two-part transfer pricing system. Next is a dual rate. Dual rate transfer pricing system. For transferor we tell yes, charge full cost plus profit. For transferee we tell yes, show it at your marginal cost. Okay, both of them are happy, promotes goal congruence, improves cooperation. But the disadvantage is that it complicates the records and profit shown is artificial. Next, we have two-part transfer pricing system. So transfer pricing will be calculated in two parts. Firstly, we'll tell the marginal cost plus a lump sum. So supplying division is happy because he's earning profit. Purchasing division is also happy because he is purchasing at a lower price. Okay, this is two-part transfer pricing system. Balance things we'll be doing in the next session. Thank you so much, students. Keep studying, keep smiling, keep rocking. Yes, life is hard, but we are strong too. So we will go through this together. We will come out stronger, successful. All these things are here to make us strong, make us worth the success. Okay, thank you so much, students.